All right. We're live. Happy Friday. Welcome in. See a couple of you joining. Let me know that you can hear me and see me okay. I want to make sure everything is working. Oh, good. All right. Well, let's take a look at some charts real quick. Bond market is going kind of crazy. So this is the 30-year uh, treasury yield up at 5.124%. You can see this big spike that's happened today. 20-year, the exact same thing. Yield is 5.144%. 10-year, same thing, 4.597%. 2-year, same thing, just not as severe. It's up above 4% now. I guess yesterday it was up above 4% also. 1 year popped and then came back down. I think 6 month. Yeah, no real movement. So just pretty much on the long end, we've got a pretty big move. And so that means if you look at something like TLT, it's the price of bonds are falling. So you look at something like TLT, get rid of that volume indicator so you can see it. Just a big gap down here. Also, it is Kevin Warsh's first day at the Fed. He was officially confirmed was it yesterday or 2 days ago? And so Stephen Moran stepped down in order to make room for him. Stephen Moran was always kind of like a temporary placeholder, so he stepped down. Now Warsh is in. Powell is no longer the chairman, but Powell is staying on as a governor. First time in 75 years that chairman has not just resigned and has chosen to stay on as governor, which he's allowed to do, but usually they just resign. And the reason why is because he's going to stay on until the investigation from the Trump administration about the building renovation costs and those criminal charges are completely gone and done. All right. Let's see some questions that you guys have thrown in the chat so far. What are your views on the interest rate in the coming decade? Will the Fed government appetite to cut rates start having less impact with time and debt, as in the market is still forcing rates high? Well, I think we're going to have a time period that is more similar to the there's some similarities to the 70s, but I think there's more similarities to the 40s. And the reason why is if you take a look at our debt to GDP ratio, let me pull up that chart. Charts, debt to GDP. Oh, this website kind of switched up, modernized. Okay, so this is longtermtrends.com. Let me zoom in here on the chart. I think you can, let me see if I can do a full view in full screen. All right, perfect. So this goes back to 1790. This is the US government's debt amount as a percentage of GDP, as a percentage of the size of the economy. You can see it spiked and topped out at 1946 from World War II spending. After World War II, that got up to 121%. After that, what they did was a combination of austerity. The government spent a lot less because the war ended, so they started spending a lot less because they weren't spending for the war anymore. Number two, they did a bunch of yield curve control. So they inflated the debt away by making sure that they could borrow at a rate that was less than the rate of inflation. And there's financial repression and capital controls to make sure that there was somebody to lend at those rates that were less than the rate of inflation. At that time, most people didn't really have a choice. If you saved money, it was in the bank, it was behind the scenes in treasuries. Very few people owned stocks, publicly traded stocks. It was difficult and expensive. Nobody had index funds. It was already illegal to buy gold. There was no Bitcoin. Real estate wasn't really viewed as an investment. Really, if you wanted to save and invest, you were going to be in bonds. So that was the combination of those tools allowed the federal government to deleverage relative to the size of the economy. And even though their total debt load grew during this time, the size of the economy grew faster. because they were able to basically print over the debt. So by 1974, over the following 30 years, they had gotten their debt to GDP ratio down to 30%, and it stayed there for about a decade. So during the inflation of the 70s, their debt to GDP ratio was really, really low. And so the Federal Reserve was able to deal with the inflation during the 70s by raising rates like crazy because the total amount of debt relative to the size of the economy was so low that the government could afford to pay higher interest rates on the debt. Now, we're in a similar situation to World War II, where the government can't afford to pay sky high interest rates on its debt. In fact, at 5%, the government is paying over $2 trillion a year. Can't even afford that. So the government needs to be able to do the same playbook from the 40s without doing the austerity piece, which is kind of a big deal. So the whole entire playbook right now is get the whole playbook is, number one, we need to force interest rates lower. And so they don't want to do that through QE. With Kevin Warsh coming in, they're probably going to do it through bank deregulation, allow banks to buy an unlimited number of US treasuries risk-free so it doesn't hit their risk limits. That will force the long end down. That will allow the government to borrow at lower rates. The second piece to that is allowing the banks to lend more to the private economy, and that will force or should enable productive GDP growth to offset any of the inflation that the printing and lending to the government might cause, and then funneling as much money as possible into things that it thinks will grow the economy the fastest. This is why you see the government taking stakes in companies like Intel. Huge focus on trying to funnel money into alternatives, energy production like nuclear. Why you see the government starting wars all over the world in order to make the rest of the world weaker and buy a bunch of stuff from the United States, like weapons and things, in order to start, trying to offload some of the costs of the debt on the rest of the world because they can't do it internally this time like they did last time. So it's the multifaceted approach, and obviously lots of those pieces are gambles. It's a question of whether it will work or not, but it seems like that is the playbook. And so I think for a short period of time we are going to see interest rates go down. If the bank lending does increase, if we do see lower interest rates for small business loans, corporate debt, mortgages, auto loans, that kind of thing, I think at least temporarily we will see a boom. And booms that are fueled by credit expansion are usually followed by busts. All right. Next question from Maher Harshith. Sorry, I'm really bad at pronouncing names, especially usernames and handles, because I don't know if they're actually real names. All right. Do you have any hedges on right now? And also any views on why oil's not moving? Oil is expensive right now. So when people say like, why is oil not going up? It's like, well, it went up a lot. Like this is expensive right now. There's probably some manipulation behind the scenes from, maybe the government is trying to manipulate the price through futures. That's possible. But just staying at these levels is like, I mean, people expect that something is just going to keep on moving in a straight line. It's like, that was a big move. It basically almost doubled from its low last year. Or maybe even, from its low 54. Yeah. Pretty much almost doubled from its low last year. That's a big move for oil. So the fact that it's staying in this range is like, that's expensive. What was the other part of the question? Hedges on right now. Yeah, I do, just very short term, small, not really large compared to the size of my portfolio, and just a little short term trade. All right, Rise RS. There's some data I released in a series of Seeking Alpha articles recently. I'd like to hear your thoughts on this data. Is there anywhere I can reach out to you through? No, I'm sorry. All right. Question from Eric Flores. What do you think about an energy crisis happening that will What do you think about an energy crisis happening that will QE like 2020 while implementing new digital system? I don't know what that question means. From Chef Boyardee, what are your thoughts on the bond market? When do you think it'll bounce back? I don't think it'll bounce back from free market forces. In other words, I don't think um, the government needs to borrow a supply of debt, an amount of debt there's just not enough money in the system right now to supply it. Uh, the vast majority of the excess reserves in the system have been drained over the last couple of years. So that's gone. Banks just don't have the ability to lend more to the government right now because of the regulations. There's opposing regulations set on banks that came in after the financial crisis. One set forces them to invest in treasuries. The other set penalizes them for how much they invest in treasuries. And so they don't have there's just not the supply out there. There's not the demand for the supply that the government needs. Um, and so that's why I think bank deregulation is coming, because Kevin Warsh has been very clear. He's going to resume, or he wants to resume, quantitative tightening and start reducing the size of the balance sheet again. The only way they can do that without causing a big, huge deflationary death spiral and, maybe even a government default and, a failed auction is somebody else stepping in to be the buyer. If the Fed's not printing money to be the buyer, somebody else has to, and probably going to be the banks. All right. Question from Vikes Draft Brain. I love bond yields skyrocketing. Glad I found the soft spot in the housing market late 2025. That's not a question. Okay. From Dave Thompson. If the Treasury continues to push everything to the short end, is there any reason to think that they'll take meaningful action to drive down long rates? Well, yeah, because if the short end starts moving up as well, like they're keeping everything at the short end right now so that it's liquid and they can easily roll it over once long interest rates go down. So if everything is at the short end and the short end starts going up, then that's even worse. um, but yeah, they're keeping things at the short end so that they can have it ready to go and easily roll it over to the long end. Can you from Rajesh Subramarian? Can you paint a picture of when the dollar loses its reserve currency? Immediate, 1 year out, 5 year out, 10 year out. Will decoupling from reserve currency help focus on domestic market producing real goods? I This is kind of a contrarian opinion in the circles that I run in. Like the people that you guys probably watch, knowing that you're watching me right now. The other people that you probably watch, this is a contrarian indicator, but it's more probably mainstream. I don't think the dollar is going to be losing reserve currency status anytime soon. Every single thing that we see going on right now around the world is solidifying the dollar's position as the global reserve currency. The Stablecoin Act, the Clarity Act, that is a kind of a Trojan horse backdoor mechanism to make sure that individuals and businesses around the world continue to use the dollar. And it's really like it's really a central bank digital currency in disguise, because stablecoins are programmable, especially the rewards and the interest rate, like to be able to just program in yield for specific countries, specific transactions, specific holding periods, in order to undercut any other currency anywhere around the world. And everybody knows behind the scenes, their money's in the dollar and treasuries, even if it might not be the best, considering the rate of inflation, it's a lot better than any alternatives that they have. I mean, that's one huge piece. Another huge piece is weakening the entire geopolitical arena around the world, starting wars everywhere, getting the rest of the world, like trying to play out a similar like World War II scenario where the rest of the world has really no choice but to start funneling a bunch of money back to America, purchasing weapons. A lot of that money coming back. Like I hope it's not true, just because I think it's probably bad for most people around the world. Um, would not be bad for Americans, but it's bad for most people. Um, Everything we see going on right now is something that will solidify the dollar's position as global reserve currency. It's not undercutting it. Will it last forever? Absolutely not. Is it going to be anything that it changes in the next 5 to 10 years? I highly doubt it. I highly doubt it. Okay. From Heisenberg, thoughts on Palantir. Let's pull up the Palantir chart. I don't think I have any Palantir shorts anymore. I did for a long time. Just kept on rolling over my puts. One of my most unsuccessful trades of all time. Let me see. Palantir. No, I don't have anything left on Palantir anymore. It's still extremely expensive, in my opinion. Very, very overvalued. Not anywhere near where it was back in this time frame. They had like a PE ratio of what, like 750 or something like that. So it's more reasonable now at 150, but I don't. It's not something that I would touch with a 10-foot pole. Given the ability of this thing to go up like irrationally, and the fact that I think it should be much lower, I'm not willing to touch this thing with a 10-foot pole. Because I think it should be lower, but again, it has the ability to, people will just buy it regardless of any logic, in my opinion, driving it much higher. And so I don't like it as a long, I don't like it as a short. Okay. From Chef Boyardee, how much cash or cash like are you holding? Percentage of portfolio. I like about 5% of my portfolio in cash right now. It's probably pretty close to 5%. That gives me some dry powder if everything goes on sale. Makes sure that if something crazy happens, that I don't have to, I don't become a forced seller at bad prices. Um, just some liquidity. I usually like to stick around that 5% level, and that's about where I am right now. Okay. Question from Ban Me Bro. How does the US refinance that 9 trillion due this summer if foreign countries are net sellers of US treasuries and Warsh doesn't intend to buy in order to run off the balance sheet? It's just rolled over. So the vast majority of that $9 trillion is going to be repurchased by the same people who currently own those bills, and they're just rolling it over. And so you've got trillions of dollars in money market funds. It's not like that's going to get pulled out. That money is just going to roll over into the next T-bills. Same thing with like money in like checking accounts and savings accounts. Behind the scenes, most of the cash in the system, you trace it back and you follow it back, and it's in the short end there. So that's where the vast majority of it is. The issue comes up with the fact that debt slowly drains liquidity from the system because it has to be paid back with interest. And so there's always more, the way that, like, money printing in the past, you had to print out a piece of paper. And so money printing in the past directly increased supply without doing anything for future demand. Today, dollars are lent into existence. And so every time a new dollar is created, that adds to today's supply, but it also means more future demand than exists in current supply because it has to be paid back with interest, even if it's, 2% or 3%. And so as that debt gets rolled over, it does suck liquidity out of the system. So that does have to come from somewhere. And with the Fed under Warsh looking like they're going to be, resuming QT instead of QE, which is what they're doing right now, it looks like that is probably going to have to come from a change to bank regulation that will allow them to just lend more money into existence without any or as much restriction. Okay. Question from Hermashith. Also, any countries or markets whose economy you are bullish on where we can look for opportunities? Looks like everywhere we are going more socialist. If you're looking for opportunities like free markets so that you can like move there or start a business there, or you just want to bet on those economies overall, a good resource is the Heritage Economic Index of Freedom. Let me pull that up. Heritage Economic Freedom Index. Okay. All right. This is the Index of Economic Freedom. And let's see the chart. Explore the data. No. View rankings for all countries. Maybe that is what I'm looking for. Overall score. Okay, so if we sort by overall score, this heritage.org, what they do is they every year they go through and they rank each country on things like property rights, government integrity, judicial effectiveness, tax burden, government spending, and then each one of those has like like subcategories that these countries are being scored on, and then these countries get an overall score based on the aggregate. And the vast majority of the time, the Singapore, Switzerland, Ireland, Taiwan, these are countries that are typically consistently in the top. If you look, if you scroll down, you notice that there's top 5, top 10, top 20, and then you get to the United States, and I think it's ranked like 26th. Oh, 22. Nice. Okay. And if you look at the history of the economic freedom ranking in the United States, it was consistently for a couple decades becoming more and more economically free. And after the financial crisis, as the politicians like to say, never let a good crisis go to waste. The increased regulation and government spending and corruption and waste and all that just started tanking the score, and it's just been moving down since then. And 2026 is looking significantly better than 2025 in terms of economic freedom, but we're still ranked not even in the top 20 around the world. And so if you are looking for countries or markets that are more free in order to try and you can invest in an index fund that is the Singapore stock market, then you can do that. One thing that I want to kind of caution is, well, two things about this if you're making investment based off of this kind of stuff. Number one, just because a place is more economically free does not mean that their stock market itself will do well. For example, it is the definition of, well, it depends on which definitions you like. You can call it socialism, communism, fascism, but state ownership of the means of production is the opposite of free markets. So when you see a government that is literally taking ownership in private companies, that is state ownership. Even though it's partial, it's state ownership, state control over the means of production. So you see something like that happen. Well, one great example of this is Intel. Look at what happened to Intel after the US government took a stake in this company. It went parabolic. It was trading in the $18 to $25 range. So it's 4, 5 to 6x since then. So just because an economy is free does not mean the stock market itself is guaranteed to outperform. What it does mean is that if you are good at business and you are good at skills at making money, you can go there and you can thrive. It might be more difficult for you to compete in a market where the government picks and chooses winners and losers. And the government can pick the stock market overall as a winner or a loser, compared to, let's say, wage earners and savers and the bottom 50% who own no assets. And so, just because a country is economically free does not mean like that, the Switzerland or the Singapore stock market is going to outperform compared to a place like America. I think the US stock market is probably going to do extremely well relative to most of the world over the coming years, specifically because of the anti-capitalist or non-free market things that the government is doing. Number two, just because a country is free right now does not mean it will always stay that way. In fact, Hong Kong used to be listed on that index. It doesn't exist on there anymore. So Taiwan is always ranked very, very highly on that list. It's possible that at some point in the future, it's not on that list anymore. You can kind of see where I'm going with that, but it might be part of a different country at some point in the future, and its economic freedom might be a lot less than it is right now. So things can change fast. All right. All right. Question from Brian. If the long end is going to get pushed down, shouldn't we get exposure to the long end of the bonds? If you want to make a trade on that, yes. I've been in my trading group. We've had a trade on TLT for a while. We've been early, like so far now. It looks like we've been really early. But yes, that is a trade that would do well if you expect some sort of action to push interest rates at the long end down. All right. From Bopjer, BAPJR. If someone with an average income, 100 to 150,000, was just beginning their investment journey, would the simple plan of investing in index funds or ETFs be wise, or would it be better to seek value? I just made a video about this. I think it went up yesterday. But when you're starting off, I don't think it makes any sense to do any sort of active investing whatsoever. The return on your time and effort is going to be like nothing, because let's say you've just started investing, and so you're making, you've got $1,000 invested, or you've got $10,000 invested. If you can increase because you spend the time, you do the work, and you just crush it, and instead of averaging 10% like the stock market does, you get 20%. So you double the market and you crushed it. Well, on $10,000, you just made an extra $1,000. So it's literally meaningless over the course of your investing career. It is much more important, in my opinion, to focus on increasing your income and getting your portfolio to a place where you've got like at least 100 grand to start investing with. Until that point, throw everything in index funds, because it's super easy to match the market. You just invest in the market. And so then you don't have to worry about anything. You just socking money away. Once you have enough money invested, like let's say 100K, then it starts to make sense to spend some time and effort on increasing your portfolio returns. Because then the same amount of effort and time you would have spent before, you're spending now, but you're making an extra 10 grand instead of 1 grand. Over time, that turns into making an extra 100 grand instead of an extra 10 grand. And then over time, that turns into making an extra $1 million. So the more money you make and the more money you have, the more it makes sense to focus on increasing your returns. But in the beginning, it's just you'd be better off spending that time working at McDonald's. You're going to make more than, and also that doesn't even take into account the risk that you do it wrong in the beginning, because it's hard to learn that stuff and you're going to make mistakes, and you're actually probably going to lose money in the first couple of years trying to beat the market. And so I always, I think it doesn't make much sense to actively invest until you have a chunk of money that is worth actively investing on. All right. El Setimo 403, you just invoked the ghost of Ludwig von Mises. Hey, man, anytime I can invoke the ghost of Mises or Rothbard or Hayek or Menger or any of those guys, Hazlitt, any of those guys, that's I think a good thing in my book. Silver Cobra says, "Did you order a Trump phone? Hope not." No, I did not. Number one, I'm an Apple fanboy. If you look at my desk, I've got a Mac Studio here. I've got the Studio Display XDRs. I've got an iPhone. I've got the AirPods Max 2. I've got the Apple touchpad, the Apple keyboard, got an iPad over there. I've got pretty much I don't know if I've like every single thing from Apple. So that's the first thing. The second thing is I this is partly about a little bit about how I was raised. When I was growing up, my dad always said, "Buy cheap, buy twice." And it's funny because my buddy, my best friend, he grew up hearing the same thing from his dad, but his dad was saying, "Buy cheap so that you can buy twice." My dad always said, "If you buy cheap, that's a mistake because you're going to have to buy twice, and so you might as well just spend the money on the quality thing, and then you have it like forever." And so I would have never, even if I did like Android stuff, I would have never ordered ordered the Trump phone. I would have been using something that was one of the proven high quality Android phones. All right. Question from Charger Mopar. Will the system ever allow interest rates to return to 1980 levels, or is revolution eat the rich coming first? Those are completely separate things that have nothing to do with each other. There are a lot of people right now that are struggling and they, want to eat the rich. Will the system ever allow interest rates to return to 1980 levels? The reason why interest rates were allowed to go up that high was because the US government's debt relative to the size of the economy was very small. It was like 30%. So that's what we were looking at earlier. You probably just joined a little bit late. This was the debt to GDP ratio in 1981. It was 31%. This is the debt to GDP ratio right now. Same level as World War II. The government cannot afford interest rates to go up right now. Back in 1980, they could. Because if interest rates go up right now, there's no way for the government to afford that. They can't just tax the economy more. Their debt load is so large, it's larger than GDP. It's 120% of GDP. And when you look at even the net debt, which is like when you account for the fact that certain government agencies hold US treasuries and you account for that, it's still over 100%. So no, that's not we're in a situation much more similar to the 40s after World War II than we are to the 80s. All right, question from DMYSNU. You say banking deregulation should come. That would suck out liquidity from economy into the government bonds. Interest for government reduces, but increases for the rest of the economy. Maybe I wasn't clear about what I think they're going to do with bank deregulation. The supplementary leverage ratio is a regulation that tells banks they have to invest and purchase a certain number of U.S. treasuries, but then it also dings them on their risk limits so that they can't really do anything else. And so there's opposing regulations there. So the removal of that would allow banks, number one, to purchase an unlimited number of U.S. treasuries, and banks can lend money into existence. And so they can literally buy as many U.S. treasuries as they want then. That's number one. So that pushes government yields down. And banks don't care about the absolute rate because they're lending that money into existence. So it's just pure profit for them. On the other hand, that will not impact their risk limits at all. So then they can turn around to the private economy and actually do productive lending for mortgages, for business loans, for auto loans, for personal loans, for whatever. They can lend money into the private economy and soak up their entire risk limits that way. Right now, a lot of their risk limits are being taken up by just holding on to treasuries, which, because of recent history, really shouldn't hit their risk limits because they're essentially risk-free. If we get into a situation where banks load up on U.S. treasuries and then interest rates spike for whatever reason and they're sitting on unrealized losses, the Fed has the ability to turn back on the BTFP, the Bank Term Funding Program, and it turns treasuries basically into reserves for banks. So they don't have to sell at unrealized loss. They can sell at full price to the Fed temporarily. And so practically speaking, treasuries are risk-free for banks. And so the idea is let them just buy as many as they want. and then use all of their risk limits for productive lending. So then what that should do in the short term, and by the way, I want to be clear. I'm not saying that any of this is like ideal. I'm just saying what I think is going to happen. The effect of that is likely to be interest rates for everybody across the board go down, and then there's a boom from all the money that's being borrowed and spent and refinanced, and budgets becoming a little bit more relaxed because debt gets cheaper. People can go spend more money. That contributes to growing incomes. So a big boom in GDP, big boom in earnings, big boom in income, and at least temporarily relieve some of the economic pain. Um, Andrew, you said I think you skipped 2 questions. I've skipped a lot of questions. There's too many coming for me to see them. I'm getting way too behind. So I apologize for anybody. If it seems like I skipped your question, feel free to throw it in again. I'm just not going to be able to get to them all, but I'm getting to every single one that I can. Okay. Question from Zero Apex Zero. Happy Friday. Do you have any opportunities brewing for us on asymmetric alpha alerts? For those of you who are unaware, that's my trade alert service. And I don't have one. I mean, as soon as I have one ready, I send it out. Um, I don't, uh, I don't have any, I don't have any coming out today, if that's what you're asking. All right. Question from Jorge Chiveri. I'm cash out refinancing at 1% when we get there. Yeah, I don't think interest rates are going to move that low. I want to be clear. Even with if we get all the deregulation and stuff that I'm thinking of, um, I don't think we're going to see. I don't think we're going to see mortgages sub 3% again. I think that ship has sailed. All right, from Vikes Draft Brain. 1940s ushered in a world war and depression recovery. Today, all we got for the debt to GDP is AI slop. The that's a false equivalence. The debt to GDP ratio did not give us AI. That's a free market production. That is something that came independently of, or actually maybe even despite the reckless government spending. The only thing that we've gotten from reckless government spending is rich politicians and rich politically connected kleptocrats and oligarchs. Expensive healthcare, expensive cars, expensive housing. Like that's the result of the government's massive debt to GDP ratio. The things that are happening in the more of the free market are happening despite what the government is sucking away from the economy, not because of it. All right. Question from FlixFlux. When will home gyms become more affordable? Rep Fitness doesn't offer any help, and noticeable increase since tariffs. I don't know what you mean by Rep Fitness doesn't offer any help. I have a lot of equipment from Rep Fitness, and depending on the equipment that you're ordering, at least when I got my big Rep Fitness rack, they have like local like connections to local people who will put together the equipment for you. So when you say help, I mean, I'm wondering if maybe you don't mean help actually building the thing. If you mean help by like offering you cheaper prices, well, every company is going to try and charge the maximum price they can possibly charge while still having their customers buy their stuff. And so if it's too expensive for you, that does not necessarily mean that it's too expensive for everybody. It just means that you want, as a consumer, to get things for the absolute cheapest price you possibly can. And the price that like the market settles at is where everybody kind of meets in between. All of commerce, all of free market commerce is just a constant auction taking place. And if on average, trying to sell things at prices that are actually too high, then customers actually won't buy them, and then the prices will come down. But I don't know if home gyms are going to be becoming more cheap anytime soon. Obviously, the number one thing that will drive down price is competition, and the one thing that brings competition in is larger profits, profit opportunities. So I think it's probably happening. There's a big wave of like health and fitness that has been growing and growing and growing. This is the first couple of years in decades where the average weight for Americans has actually been decreasing. So pairing it with like GLP-1 drugs that are helping people actually lose fat that they felt like they can't, and getting that flywheel started of people, trying to become more healthy. I think home gym equipment is probably set to become more and more popular over time. That means that probably prices will stay high for a while until it becomes, until it's brought in enough competition to bring prices down. All right. From Rajesh Subramanian, outside of precious metals, what would be a hedge against a government default within the borders of the country? Outside of precious metals, probably Bitcoin. Um, Probably just like puts on the stock market. All right. Question from Brian LD567. Are you still looking for traders? I'd like to join your group. So far, up to this point, the only the way that I sell access to my trading group is through the webinars that I run. So every once in a while on YouTube, you'll hear me talking about an event that I have coming up. And I'm going to be talking about something that's going on in the economy. And the reason why I use those as opportunities to sell access into my trading group is because, in my opinion, I feel like I need to set proper expectations for what you are going to be getting out of it. Um, and the best way to do that is to have a long time to be able to explain it to you. So I don't have any like landing pages or easy ways for you to find access to purchasing access to my program just voluntarily, because I like the opportunity to explain what it is that you're getting. That will probably change at some point in the future. If you really dig hard through my website, you can find access to it. But I would just recommend next time I run an event, just joining that event. All right. From Martin Fenton. Any thoughts on the Clarity Act passing the Banking Committee yesterday and the Clarity Act moving forward? Yeah, I mean, I think it's definitely going to get passed. I would bet I'm betting on that. One of the reasons why is because a bunch of the big banks just recently started posting a ton of job openings for like crypto positions. Um, it's like they know it's coming and they're preparing for it. So I think it's moving forward. It's also a big piece of this administration's plan to solidify dollar usage around the world and get that money to flow back into treasuries so that that money doesn't exit the US system. So I think it's going to happen. Will there be more changes to it before? I don't know. But it looks like the industry insiders are now bracing for it to come and pass and for it to happen. All right. This is from Raider number 42. Based on the current economy, can you estimate when my dad will come home from getting milk and a pack of smokes? Soon, buddy. He'll be home soon. All right. From MI Fishing Guy. Do you see housing prices coming down similar to 2008 when things finally do crash? It seems like private credit is a problem and getting worse. While it is not subprime mortgages, it's still a problem. No. There's two parts. So private credit and mortgages, housing prices completely unrelated here. Private credit is a problem. This is another reason why I think bank deregulation is coming, because private credit blew up, became so popular because banks were not able to fill that lending role in the economy anymore. But the demand for borrowing still existed. And so it got forced out into the shadow banking system where they were able to charge way more because they were the only ones who were offering the debt. And so it created this absolute monster. This is one of the there's regulation, over regulation, or any regulation at all breeds unforeseen consequences. And the fact that they came in and tried to prevent banks from being able to repeat their same mistakes instead of just letting them fail. They said, okay, we're going to bail you out, and now we're going to make it hard for you to do business in the future so you can't repeat the same mistake. Well, that just forced all of that business out somewhere else and created a shadow banking monster in private credit. And now there's some big boys who are in trouble, like pensions, and that means that it's probably going to get bailed out through bank deregulation. In terms of mortgages, I don't like making videos on the housing market because people get really upset at the idea that they may be wrong about every, everybody thinks the real estate market's going to crash. Everybody and their mother-in-law and their brother-in-law have been waiting on the sidelines to buy a house when the crash finally comes. And it's not happening. The demographics will not allow it. Number one, when you look at housing units compared to population level, meaning you control for kids, it is way lower than it's been historically. There was a huge building stop that happened after the financial crisis, and it never recovered. There are more people who need a place to live than there are places to live. The one thing that probably could have changed the huge demographics imbalance would have been mass deportations, because that decreases the population. That didn't happen. That's not happening. Number three, there are way less people per housing unit than there used to be. So it used to be 4, 5, 6 people lived in a 2-3 bedroom house. That doesn't happen anymore. Now you have 1 or 2 people living in a 1 or 2 bedroom apartment. The number of people per housing unit has gone way down over time. So not only do we have fewer housing units per person who want a place to live, but we have a need for more housing units per person who needs a place to live. And nothing about that has changed in the past, decade plus. Also, most people, 50%, or I think it's 40% of people who own a house right now are mortgage free. So you've got a massive chunk of homeowners who cannot become forced sellers. That did not exist in 2006, 2007, 2008. Number two, of the people who have mortgages, the vast majority of them have interest rates under 5%. A lot of them have interest rates under 4%. So all of those people, you take a look at the non-mortgage people and then the cheap mortgage people, none of them can afford to sell. If they sell right now and they move to a new place, an equal-sized house or even an apartment, because rents have gone up, they're going to be paying more than what they're paying right now. Like, their budget will not allow them to sell. And so until interest rates move down, you have most housing that just cannot sell. That's why you see supply so high right now versus buyers. And also it hasn't caused a crash like it did in during the financial crisis. Because there's a lot of people who are like, hey, if I can get a certain price, I'd like to sell, but I'm not a forced seller. So if I don't sell, I'm just going to pull my house off the market, because I can't, I have to get a certain amount or else I can't afford to actually get the next place. So if we see interest rates come down, that will unlock a lot of supply. A lot of people will be allowed to move, but they're going to be moving somewhere else. Like, it's not like they're going to leave the housing market. They're going to be buying something else, or at least renting from somebody else, which will jack rent prices up, which means that there's more demand for landlords to buy houses to rent out. And so either way, we don't have the demographic situation for a housing crash. All right. From Volgavana White, thank you so much for the super chat. I appreciate it. Is Nike a good trade right now, or do you see more downside? I don't like catching falling knives. Let's take a look at Nike. I went long Nike in here because I thought we were going to see a breakout to the upside, and then I exited my long when it failed to the downside, because these are directionally agnostic setups, and so whichever side you see a breakout from is where you expect the move to happen. So since the breakout happened to the downside, it's look out below. We also see testing of support right here, kind of broke down beneath it. If we get rid of the 200-day so we can make that bigger, we might have just confirmed holding below support here with this big candle today. This looks like a really, really dangerous short-term bearish setup to me. So in my opinion, like, I'm not looking at Nike right now as a good buy. for something like this, which was a really, really solid company for so long and then has had such a massive, massive failure, and such terrible performance, I would personally want to see a major turnaround, leadership, strategy, earnings before I start to touch this thing. And does that mean I would miss out on the bottom? Absolutely. But it also means that I'm not catching a falling knife and maybe getting stopped out over and over and over again on the way down. Because how much lower can it go down from here? It can go down 100% from here. It can always go down 100% from wherever it is. It's gone down, how much is it? How much is it down from the top? It's down 76%, 77% from its top right now. People say, how much lower could it go? It could go down another 100% from here. That's how percentages work. So no, I'm not a fan right now of companies like that have had big failures and big turnarounds in the wrong direction. I like to wait until there's some proof in the pudding that they're going the right direction. All right. Question um from Brian Ebel. When does gold stop going down? Um, well, first I would like to say, what do you mean going down? Do you mean this little correction that it's had from the very, very top after this massive bull run? Is that what you mean? When will gold stop going down? um, I think that gold is going to be in this range between, let's call it 4,000 and 5,500. I think it's going to be in this range for a long time. The reason why is because gold anticipates monetary policy, and we're entering into an easing era, and we're exiting a tightening era. The I know most people don't like to hear this, but the Federal Reserve has been engaged in very tight monetary policy for years now. Let's take a look at what I mean by that. Okay. This is the Fed's balance sheet from 2022, May of 2022 through November of 2025. They were decreasing the size of their balance sheet. That is literally sucking liquidity out of the system. When you look at the reverse repo facility at the Fed, let me pull that one up. This is where the excess liquidity was sitting. There was over $2 trillion in this facility. And over the course of their tightening, they brought it down to zero. So literally $2 trillion of reserves disappeared from the system. That's liquidity gone. The Fed did this to try and counter the inflation that they produced from 2020 to 2021 printing, but and clearly it wasn't enough because inflation has never gotten back down to target. But the fact of the matter is we've been in a financially tight environment, monetary environment, this entire time. And that is changing now. Or at least I think it's going to be changing, is if they do actually deregulate the banks. We're entering into and by the way, right now they are doing QE. So Kevin Warsh has said he's going to come in and stop QE and resume QT. If he does that, we're still in a tightening era. If he doesn't do that, then we're still slowly getting into a new time period of easing. The money supply has continued to grow over the last 2 years or so, even despite the Fed's tightening, and that's because of bank lending. That will explode if the banks are deregulated. So I think gold will stop going down or moving side. I think the gold is going to be moving sideways for a couple of years because it has already made its move in anticipation of the easing that is coming. All right. Question from from Dreamhopper. Thank you for the super chat. I appreciate it. Can you take a look at BTG long-term calls? What is BTG? B2 Gold Corp. Market cap 6.5 billion. All right, zooming out. $5 a share. Well, number one, this is a fairly volatile stock. I mean, percentage-wise, in 2020, it topped out at $7.50 a share. And over the course of the following 5 years, it dropped down to $2 a share, 220. That's a 70% drop from top to bottom. And it has recovered somewhat, not all the way. It's up 100% from its bottom there, a little over 100%, which, by the way, that shows you guys a 70% drop needs a lot more than a 70% gain to get back up to where it was before. A 70% drop actually needs a 240% gain just to get back up to break even. Losses are more powerful than gains. That's why you always should manage risk as your number one investing rule. Never have large losses. One of the reasons why I'm pointing that out is because there might be better. This is clearly not performed very well. Since its IPO, it's about on par with GDX. If you look more recently, let's say the last 5 years, GDX has significantly outperformed. BTG is down 4%. GDX is up 122%. Over the last year, about the same. So obviously it depends on the time frame that you're looking at. But my question would be, why over most time frames is BTG so significantly underperforming the index? At best, it kind of matches the index over certain time frames, but most time frames it severely underperforms. This is one of the reasons why I don't really like, personally, picking and choosing individual mining stocks. It's just extremely difficult. It's extremely difficult. I like the indexes for miners. All right, question from her Hashith. Off topic, but thoughts on why birth rates around the world are falling. I read Taiwan has 0.55 children per woman, and its impact long term investing with a 30-year time left like me. This could be wrong. This is an opinion that I don't know if it's backed up completely by the facts. So I want to preface this by saying I could be completely wrong about this. It seems like for most of human history, the average birth rate has been around 2 to 3 kids when you account for how many of them died. So like when you look at just the survival rate, like how many of your kids make it to adulthood, usually it was around, 2 to 3. For all of human history, in order to get to that point, you needed to have like 6, 7, 8, 9, 10 kids. Usually that would kill the mom at some point in childbirth as well. And you had to have because so many kids, it's for all of human history, it's been so difficult to literally just survive, to not die. It's like the bare minimum. It just absolutely almost impossible, to the point where human population just didn't grow that fast because so many people just died. Early 1900s, medical advancements meant suddenly people start surviving. Like that's when infant mortality just started dropping off of a cliff. Like absolute miracles in medicine and modern technology. And there was a crossover period where people were still under the habits of having as many kids as their ancestors and their parents and grandparents and everybody had always had. So you got like 1 or 2 generations where everybody was still having 6 kids, 5 kids, 4 kids. But then eventually it trends back down to the normal, and people start, in order to have 2 to 3 of your children making it to adulthood, now you only need to have 2 or 3 children. Um, so I think that has a huge part to it, is that we're comparing birth rates to the early 1900s, and based on infant mortality, that was an anomaly in human history. We're like now having the same number of kids when you can like are just looking at like survival to adulthood. The second thing I think does have a lot to do with like financial stability and money. When you look at places that are a lot harder, their birth rate is a lot lower. Um, although I take that back, because there are places that are like really poverty stricken that that the birth rate is just sky high. So culture definitely has a part to play in this as well. There are a lot of like Eastern Asian countries where the birth rate is super low because they won't start relationships, they won't get married, they won't have kids until they're like financially successful enough, but the opportunities are really low, so it's very few people actually get to that point. Um, so I don't know. I think culture and beliefs have a big part to it. When you have a belief system that is shared by most people that is pro human life, um, values that value more humans, that tends to express itself by people having more kids. When you have uh, other worldviews that are more nihilistic, more everything in the world is terrible. Why it's wrong to bring a kid into this world with how evil it is and how broken it is and how all these things that are wrong with everything. Like there's no way I'd bring a kid into this world. It's like that's going to decrease birth rates, number one. And number two, that worldview is a self, what's the word? A self, um, it's going to be outcompeted by the worldviews that end up with people who have more kids. It's over a longer time horizon for sure, but the worldviews that you see that end up having families that have more and more and more and more kids, those are ones that in the end are going to persist. Just like cannibalism, it's like it's a worldview and a belief system and a culture that really is not something that can spread its way throughout all of humanity, because it's like a self defeating worldview. So, all right. From deplorable AK4. How high do you expect home prices to go up after this next round of cutting interest rates? 25% over the next year. Yeah, I don't know. It depends on what mortgage rates do. There's a chance that before midterms, there's some executive action in order to force mortgage rates lower. I think there's more than a chance. I think there's a good likelihood of that, but obviously it depends on how much interest rates go down. I don't think there's going to be a big frenzy like we saw in 2020 or 2021. Um, but I think it'll probably make the nationwide average trend resume its way up. It's nationwide, the median home sale price. Let me pull up the chart. Fred median home sale price. The median sale price of homes has corrected from its peak in 2022 at 442,000 down to 403,000. So a 10% correction. I would anticipate that it resumes its climb probably on trend from 2011 through 2019, like this type of direction. It would resume that trend higher. I don't think we're going to see like a big huge frenzy, but I could be wrong. All right, question from It's Valen G. I have zero debt outside of normal monthly expenses. Why are your normal monthly expenses, why are you considering them debt? I have zero debt outside of normal monthly expenses. I have 100,000 invested and I rent. Would it be wise to take out of investments to own property or hold off? Um, Well, let me answer it a different way. I prefer personally about 30% in stocks, 30% in real estate, 20% in gold, 5% in Bitcoin, 5% in cash and cash equivalents, and about 10% reserved for speculative trading, active trading. Um, when the smaller your portfolio is, the harder it is to have an allocation like that. You're going to be unbalanced in some way. So there's nothing wrong with building up one part of your portfolio at a time. Um, right now, I mean, it's up to you. You're always going to have to live somewhere, and rent prices will always increase. So you have to take that into account. Um, the other thing you have to take into account is there are expenses with buying a home that are like that. That's not usually a purely financial decision, and it probably shouldn't be. When you do move into a home, you're going to be buying a house that is somewhere that you want to live for probably a pretty long time. You're going to start doing stuff to the house that you wouldn't do it to a house you are renting. Um, you're gonna like there's just more expenses. There's also more risk too because it's on you. You haven't, you're not spreading out the risk of something going wrong with the house over many years, spread out to landlords. So it depends on your situation. I would say for most people, just don't trick yourself or fool yourself into thinking that buying a personal residence is a financial decision. 8 times out of 10, it's a lifestyle decision. I finally want to move into a neighborhood that I actually want to live in, and there's no houses for rent there at any reasonable price. And so I want to upgrade my lifestyle, and that's something that you can do if you can afford it, but probably shouldn't do if it's a huge stretch. Um, from El Sedimo 403, 50,000 Lake Tahoe homes are set to lose 75% of their power as it's redirected to data centers. That's just not true. That's it was like it's literally it's literally like a false headline that was just going viral across social media. None of those houses are losing any power. The power behind the scenes, it's just switching where it's coming from and where it's going. None of those houses themselves are actually going to lose power, though. That's just not true. Look it up. All right. What do you think about the SpaceX IPO coming up from Metallica? Um, I generally stay away from pretty much every IPO. I do not like investing in IPOs. And the reason why is because you tend to see the same pattern unfold. Let's look at Coinbase because that was a good example of this. This is typically what happens when a company IPOs. They get a bunch of retail hype, they pop, and then they dump. And it's because all the insiders eventually start getting out, all the lockup periods end, early investors take their payday, it's an exit, and then retail is left holding the bag. They sit there on all their losses, and then they finally start licking their wounds and walking away and closing out because they're like, man, this is not doing what I thought it was going to do. Eventually, once everybody has finally capitulated and gotten out, the stock settles on a new low price, and the company starts finally proving and doing some of the results that people expected from the beginning. It just takes them a lot longer to get there. And then the stock starts to recover and move up from there. This happens not with every IPO, but with many IPOs. Circle is a recent IPO, did the exact same thing. Big retail hype, pop, and then a big dump. Who knows if that's done yet? Rivian, same exact thing. Big pop and then big dump. We'll see if that bottom that it's put in here is legit. Bouncing off a support right there. Dangerous place, but might be another bounce. What are some others? Robinhood, same thing. IPO, big pop, big dump, base, and then finally starts performing. So you get the picture. That's typically what happens on IPOs. Does it happen with every IPO? No. But when a company like SpaceX is IPOing at a valuation of whatever they, are going to IPO at, 1 trillion, 1.5 trillion, 2 trillion, whatever it ends up being. And they're getting rules changed by the indexes in order to allow or force more money to flow into their shares than like typically would. Then it raises the question of like how overvalued, at least in the short term, is this stock actually. And so I don't like touching them. I don't like touching IPOs. Sometimes if the company is like, every once in a while, I think it's worth it to risk it on, but not if a company looks like it's potentially extremely overvalued. But we'll see. All right, question from Live for Christ 9X X91. Any recommendations for where to keep a portfolio? Also, any recommendations for a trusted broker account for trading? They're all good. The only ones that I always say that I stay away from is like Robinhood. I don't like them. I don't like their shady practice of like how they've locked people out of accounts, their lack of customer service, the way that they make their money by routing order flow to their hedge funds behind the scenes for front running, high frequency trading and front running, the bad order execution and fills that people get that they don't realize they're paying 10, 20, 30, 50, $100 more per trade or costing them per trade because of bad fills. They could have gotten order improvements somewhere else. But anywhere else is good. I like M1 Finance for like setting up an automated portfolio, because a lot of the automated portfolios elsewhere, like Fidelity Go or Schwab Intelligent Portfolios or Betterment or Wealthfront, those pick the investments for you, which is fine. There's nothing wrong with that. It's just basically you're in a index fund account or like a 60-40 type of portfolio. M1 Finance allows you to just choose the investments, but it still then automates it. So it says you're choosing the percentages. So I want like these 10 stocks or these 20 stocks. And then anytime you put money into the account, it automatically invests it. And you can even do, auto transfers. So you can set up on autopilot just like those other automated accounts, but you get to choose what it's actually invested in. So I like that for setting up the automated long-term portfolio. For active trading, Schwab, Fidelity, Interactive Brokers, Webull, Moomoo, TradeStation, whatever you want. If the user interface is good, you like the website, it works, it's not glitchy, and there's customer service so that when something happens, you actually can call and get a real person on the phone. Those are the things that I think matter more than anything else. All right. The missing tile 2828. Of course, I come late. Yeah, I've been going for an hour, but I plan to keep on going for a while longer on this stream. So ask any questions that you have. All right. This is from Mahermashirth. Does inverting demographics, i.e. more retirees selling stocks, a concern for long-term investors? Yes. 100%. So for a couple of decades, the market has had a consistent value and price agnostic bid, meaning people get money in their paychecks and a portion of it just goes and buys everything in the stock market, pays no attention to price, pays no attention to value, just says, I have money, go buy. And that has grown over the past couple of decades. That's one of the reasons why you have so many companies, why like old traditional valuation metrics have really stopped applying, because there's just so much money that gets funneled into the markets and it buys it no matter what. Demographics means because of how many people are entering and nearing retirement, some point after 2030, that trend is very likely to reverse, meaning you're going to have more people selling and pulling money out of the market than there is going in. Which reverses that process of everybody is selling everything again, regardless of value, regardless of price. So that doesn't necessarily mean that markets will crash. It does mean that there's far more likelihood that we will see irrational valuations on the undervaluation side. Like we could see things, we could, in the next couple of decades, we could see markets where like Benjamin Graham's intelligent investor investing style becomes possible again, where there's like cigarette butts and there's companies trading below book value. And it's like so much money just starts selling everything just because the money needs to get, needs to get spent, that it presents opportunities across the board. So for anybody who's young, it's like we want that to happen. You want markets to present opportunities and to present value. That is a good thing. It means you're able to pick things up at prices lower than where they really should be. And in the long term, then you get to that's what builds fortunes. But in the short term, that means market pain. Now, a couple of caveats to why that may not actually happen. Number one, enough money printing means that there's always a new dollar supply coming in to the lower end, the earners and the wage earners who are investing, to funnel enough money into the markets to compensate for the money that's being taken out. And so, depending on what we see happen with the money supply, with borrowing, with lending, with yield curve control, with government spending, with all that, it's possible that, whatever that means in real terms after adjusting for inflation, we don't know. But at least nominally, markets can keep on actually going up despite that demographic shift. That's number one. Number two, what is number two? Oh, number two is that money doesn't actually get destroyed. As boomers retire and start taking money out of the markets, it gets recycled back into the economy through consumption. And so that directly contributes to GDP, that directly contributes to earnings, that directly contributes to incomes and recycles into the economy. So even if there's a period of time, whether it's 1 decade or 2 decades or whatever it is, where the markets are just experiencing like a lost decade from just money just getting sucked out, that money then gets recycled into the like it could be a very, very good time to start businesses and to take advantage of all of that wealth leaving markets and entering the real productive economy. A kind of a reversal of what's been happening for the last couple of decades. So just because we have problems on the horizon doesn't mean you're destined to lose money. In fact, problem means opportunity. You just have to know where to look and have the eyes to see it that way and to ask, where can I make money in this? Because there's always going to be a way to make money regardless of the type of economy that you live in. All right. From Ginger 2. You said that a bubble isn't typically a bubble if everyone is saying it's a bubble, but doesn't that describe NFTs? I no, I don't think so. This is why it's kind of hard. Like with the way that the internet works and social media circles work, it's difficult to see like consensus, and you can get fooled into thinking like the narrow area that you're in is consensus, and thinking that you're contrarian, then you're just going out and having a mainstream opinion on something. The mainstream opinion was that NFTs were not a bubble. The mainstream opinion on everything was that everything was not a bubble in 2020 and 2021. So if you were seeing, and it seemed to you like everybody thought everything was a bubble, it was probably just because of the people you were paying attention to, and that was a minority position. But most people thought NFTs were going to be revolutionizing everything, and and the entire world. That's why so much money rushed into it. So also, yeah, no, I don't think that accurately describes NFTs. Okay. From GNGR2, Fidelity just recommended their separately managed account service at 0.4% annually. Are you familiar? In my opinion, this is not advice for anybody. This is just my opinion. I think there are two options that should be considered and nothing in between. Option number one is the absolute cheapest index fund type of account you can possibly get into. So that would be something like if you invest at Fidelity, that would be Fidelity Go. They're going to put you in, 5 mutual funds that are index funds, super, super cheap. I think Vanguard has a similar product. Schwab's is called Schwab Intelligent Portfolios. Very, very cheap to free for the management of the account. And then behind the scenes, you're in extremely cheap index funds. The performance there is going to be many times better, oftentimes equal, and very rarely underperform the actively managed accounts, whether that's separately managed accounts at Fidelity or other services like that at other places. And other places like, they'll charge way more than 0.4% for it. On the opposite side of the spectrum is you actively invest your own money. Because if you're going to shoot for active investment, it's better to know what you are doing and do it yourself and learn it yourself, and not pay somebody else who's literally just going to be putting you in something that's going to be very, very, very similar to the overall market. The entire financial industry is designed to de-risk themselves. So if they make bad bets, the rest of the market goes up and they underperform, they'll lose all their money. Like nobody will stay with them. If the market goes up and they crash, nobody's going to invest with them. But if they basically mash the market and they crash with the market, then they'll say, "Hey, look, we couldn't control this. Like the market crashed. Like, what are you going to do?" So the incentive is to for these expensive managed accounts to replicate what a cheap or free index fund account will do. And they're never going to be picking, 5 to 10 individual stocks, especially if they're concentrated in specific sectors or something like that. And if they're good at it, they're not going to be doing it for 0.4% at Fidelity. They're going to be running their own fund. So I think it doesn't make any sense to do anything other than those two extremes, either free index funds or actively invest your own money yourself. And there'll be a learning curve. For the first couple of years, where I was learning how to trade for my own account, I lost money. My 5-year compounding annual growth rate is 39% right now. So I've figured it out. I know how to do it. I know how to make money. I beat the market, but it's hard. And it took a long time to get to that point. And I don't manage anybody's money. So the people who know how to beat the market are typically just doing it for themselves. Now I do share my trades with my trading group, but I don't manage anybody's money. All right. Live for Christ. Thanks for answering, Joe. God bless you, man. I learned so much and get so much more insight when watching your videos and taking your courses. You're a real dude. Much respect. Thank you. Well, thank you. Very kind of you to say that. Appreciate it. All right. From Guitars and Adam. As far as housing, I think as the baby boomers move on, the inheritors won't have the money to upkeep the property, like taxes, paint, roof. There will be big selling pressure, maybe. Yeah, maybe. It just depends on, again, demographics. Are the people who are dying, like, is it enough to actually shrink the population? And then if so, if the population in total actually starts declining, then yeah, that's downward pressure on everything. Like a demographics implosion where the population actually starts shrinking is like, it's almost impossible to fight demographics. This is the reason why China is struggling so much. It's like demographics trumps everything. Like you cannot, whether it's monetary policy, fiscal policy, demographics is the number one driving force of everything. So you don't want, like, I mean, it might feel nice to say like, oh yeah, then I can afford a house. It's like, yeah, well, watch what your income does. If the population starts shrinking, like probably not good. All right, let's see. Question from Andrew Gorodisky. Can the Fed take debt away as repo by sucking it out as liquidity from banks and make as this money never came into the market? Can debt disappear? Money can't be destroyed. Money can be destroyed. So money, this is how money comes into existence and leaves existence. Debt and then deleveraging. Money gets loaned into existence, and then when debt gets paid off, it leaves existence. It gets destroyed. It ceases to exist. That is literally how money works. That is how, in the fiat world, how the dollar system works. Dollars come into existence when new debt is created. That money, dollars are lent into existence. And anytime debt is paid off, those specific dollars get destroyed and they cease to exist. Because uh, when debt is created, there's no such thing as money going from like the bank account at Chase, like they have their own like secret hoard of money, and then they take it from their account and they place it in the account of the person who just got a mortgage and bought a house. It's like that money didn't exist before that. It was lent into existence. They have rules and parameters on how much money they can lend into existence, but it's just typing on a computer. It didn't exist before, and they just, on the computer screen now they, bloop, yeah, ding, 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 like money just came into existence because their loan was created. Every time you pay off debt, those dollars leave the system, that liability and that asset on the balance sheet of the, in this case, the credit card company, it disappears. It ceases to exist. It's not like that dollar is now sitting in somebody else's account. It's just gone. Now, most debt just gets rolled over, meaning when some dollars go to pay debt off, it then like new debt comes into existence, sometimes to the exact same people. So like when you put your money in a savings account, behind the scenes, it's in treasuries. That treasury at some point gets paid off, and then it just gets paid off back to the bank, and the bank turns around and reloans it back out to the US government. But that dollar first got destroyed and then it got created again. A new one got created for the new loan. So that is the life cycle of a dollar. It's lent into existence. And then when debt gets paid off, it ceases to exist. It's just that on net, there's more debt being created than there is debt being paid off. And that's why the money supply continues to grow. All right. From the Kurofaust, what is your investment allocation? I did not get that. 30% stocks, 30% real estate, 20% gold, 5% Bitcoin, 5% cash or cash equivalents, and then 10% in like speculative trading, like active trading. The reason why I prefer that portfolio is because when you chunk it out, it's like 30% business stocks. That's like capital appreciation, 30% real estate. That's for tax benefits, debt leverage benefits, and scarce resources, cash flow. And then it's like 30% in reserves, things that will, are like money type of alternatives. And then like 10% for things like hedging or speculative trading, asymmetric trading, that kind of thing. It's overall kind of a very similar allocation to 60-40, but instead of 40% in bonds that are going to underperform inflation forever, that reserves portion of your account is in something that actually will protect you against most inflation. So that's why I like that portfolio mix. All right, question from Ginger 2. Just want to say thanks for taking the time for these. Always a great way to wrap up my day and challenge some of my ideas. You're a good content creator. Well, thank you. I will keep on doing these lives and making videos as long as you guys keep on watching them. By the way, I don't know. I mean, you guys probably don't pay attention to this like I do. I've had my subscriber number. I've been at 399,000 subscribers for like 6 months now. And it's really like, it'll creep up. And then once it gets close to 400,000, it'll like drop back down again. And I'll go through for the last like 6 months, maybe longer now, periods of time where it's just like, I'm just losing subscribers. And I think, I could be wrong about this. I think YouTube is slowly trying to fix their bot problem. and purge bot accounts, but they don't want most creators to get discouraged about seeing their subscribers just tank. And so they'll delete bot accounts in proportion to how many new subscribers you're getting. And so I could be completely, this is just a theory. I've got no evidence to back this up other than the fact that this is the first time since 2019 when I started making YouTube videos. This is the first time where my YouTube channel like has literally stopped growing. So, I don't know if that's real or not, but I'm bringing that up to say that like I don't use vanity metrics like that to determine whether or not like I should, keep on doing this. I'm going to keep on making these YouTube videos. I also don't think subscribers matters at all anymore. Like personally, I don't subscribe to any YouTube channels. There's a lot of YouTube channels that I'll watch a lot of their videos, not subscribe to them. The YouTube algorithm is so good now where it just will recommend the videos that it thinks you want to see based on the videos that you've watched in the past. And the longer you watch a video for, the more YouTube's like, oh, you really like this content. If you watch the whole video, it's like, oh, you really like this. I'm going to feed you more videos like this because the whole point is to get people to stay on the platform longer. Um, and so the only like the biggest metric that matters for for YouTube is just watch time. Um, but but it is funny. My subscriber growth has been stuck there. So, but luckily I'm not. Let me know in the chat. Are we back? Are we still live? Is it still working? Oh, we're back. Okay. I think you answered your question on why your channel isn't growing anymore. You're not subscribing. The algo is so good. Yes, many are doing the same. Yeah, I think that's a huge part of it. I mean, I am seeing new subscribers come in, but again, they're leaving at the same time, like others are leaving. But anyway, maybe I should stop talking about this because YouTube just tried to kill the live stream since I was talking about it. So I'll go back to to answering your guys' questions. All right, let's see here. From Two Fuzzy Slippers, finally caught you live. Is there a website where I can see money flows across or between sectors on a daily basis? No, I don't think so. I mean, you can just compare the performance because if the relative performance is up or down between two different sectors, that means money is flowing in one and out of the other, like relative to each other. But you can't see like money flows specifically because every time something is bought, there's also a seller. So like anytime a transaction happens, there's money flowing. So there's a cash on one side and the shares on the other, and they're trading hands. You can't have buys without sells. You can't have sells without buys. So it's not like money is flowing out of a sector or into a sector. It's that cash is moving from one person who wanted into that sector and it's going to another person who wanted out of that sector. It's one person who wanted that share to another person who didn't want that share. So the idea that like money flows into real estate or out of Bitcoin or into gold, or it's not actually how it works. Money moves from one person to another person, and then the ownership of that asset just changes hands. The money stays money. The dollar stays dollar. It stays in the banking system. All right. Let's see here. From Ray Metz, 45, 46, 30% real estate, 30% stock, 20% gold. So that's my preferred portfolio allocation. How does that change in retirement when a typical 80-20 changes to 60-40? How does your portfolio change? Stocks would move more from growth to income, so more to dividend stocks, and maybe increase the gold allocation, the cash allocation, be a little bit more heavy on the conservative side. From Joseph RJ1U, usury is against God's law. Great. I'm so glad you said that. I have strong opinions on this. I think I made a YouTube video about this one time. I'm pretty sure I did. I'm pretty sure I have a video called Why the Bible Outlaws Interest or something like that. Um, the reason why, just so you know, like the rule of thumb, if you're reading anything that was written prior to 19, let's just call it 13, money equals gold. Prior to 1913, for all of human history, if you are reading anything written prior to 1913, whether it's the Revolutionary War, whether it's, Plato, whether it's the Bible, whether it's, whatever it is, you see the word money, you see the word shekel, shilling, you see the word like whatever. It's always talking about gold and gold or gold and silver. That's what money was for like all of human history. And so that is really important to understand because when money is sound, in other words, it cannot just be new supply cannot come into existence through the decision of a policymaker. New supply can only come into existence through like physical labor to get it out of the ground. That means the only time the supply of money grows is when the cost to produce it is smaller than the value of the actual money, which means that if you start producing more and more of it, the value just from supply and demand starts to go down to the point where eventually it won't be profitable to produce any more of it. So the supply will balance out. So for all of human history, the average growth in the money supply was always like 1% to 2%, because if it grew faster than that, it got to the point where it wasn't profitable to get it out of the ground and refine it and mine it anymore. And so then it stopped growing. So kind of like the natural built-in, check on the growth in the money supply. That meant that for the most part, prices of everything else slowly declined throughout time. We have a lot of data from the time period between 1870 to 1910. And it provides a little snippet into what most of history looked like that we just don't have the data for, or at least as good of data for, where the growth of stuff in the world, the production of real goods and services that people want and use, that grew and it kept on growing faster and faster, but it grew faster than the money supply grew. And so prices went down. It's the opposite of today. Today, the money supply grows faster than the stuff. And so when you live in a world where for all of human history, prices slowly go down over time, you will increase your purchasing power simply by saving. Which means that if you lend your money to somebody for 0 interest rate, you are actually in a better position, as long as you trust the person who you lent the money to give you your money back. You're in a better position than holding it yourself, because if you hold that yourself, you're at risk of getting it stolen or losing it. But if you lend it out, now you have an IOU that is worth the exact same amount, again, as long as they pay it back to you. You're still increasing your purchasing power because of deflation. And so the borrower, in some ways, does a service to the lender by keeping their wealth safe. And so by charging an interest rate on top of that, it's putting the borrower into a really, really tough financial position, um, because over time it becomes harder and harder and harder to get your hands on new money. That's what deflation means. So there's a built-in interest rate on saving. And so for most of human history, that's why it was considered so bad to charge interest rates, especially exorbitant interest rates, but interest rates at all on debt, because you could just make money by just saving. Fast forward to now, the situation is different. Money loses value over time. And so just to get back to that exact same, like increasing purchasing power, you have to charge an interest rate that is at least a little bit higher than the rate of inflation. And so that's why usury today is viewed as exorbitantly high interest rates, because then it's like the same thing as any interest rate at all 1,000 years ago. So it's just a difference in money mechanics. Why it was so looked down upon. Okay. From Cade Wilcox, do you tithe? What does that look like from a regular investment account, Roth 401k? Okay, this is a little bit of a heretical view. Um, the Most people think that that tithing means, like, from a religious perspective, if you're a Christian, if you've gone to church, whatever, that most people think that the Bible says, hey, you should give 10% of your money to the church. It never says that. That was a policy that was invented in, like, medieval Europe, in order to, and it basically operated like a government tax because the church was like the landowner. Um, Biblically, the tithe is 23 and a third percent in the Old Testament because there were three tithes. Two of them were annual 10% tithes, and then one of them was a 10% every 3 years. So on average, it was 23 and a third percent. And it was basically the functioning of their government. So it was like their version of like a tax system, because they had like there was 100% like conformity between their like government and their religious system. It was like the same thing. Also, the whole point of it was to take care of the people who were in need, like the widows and the orphans. That's why in Micah or Malachi, I can't remember. It says, "Bring the full tithe into the storehouse, and see if I will not pour out my blessings on you to the point where you can't handle them." Because the point is to bring food into the storehouse. It's for the people who cannot provide for themselves. Um, and when you get to the New Testament, everything that Jesus talks about giving, basically, like when he talks about who's going to make it into the kingdom, he never says, "Oh, it's the people who believe in me." He never says, "Oh, it's the people who pray this certain prayer." He never says, "Oh, it's the person that has enough faith or that thinks the right things about who I am or who God is or knows the right things theologically or anything." Basically, he says it's the people who take care of those who are in need. Um, he says it's the people who clothe the people who need clothes, who feed the people who need food. Anything you do for the least of these, you've done for me. Um, and so I have very strong opinions about giving, and zero of that, in my opinion, is money that should be going to a church organization that has a building to keep the lights on, to keep a pastor with a salary. By the way, pastors with salaries didn't exist in the Bible. That's a new thing. That was not a that was not something that that was not something that existed around the time of the writing of the Bible or before. Um, that's why Paul was a tent maker, because all Pharisees had a career, had something that they produced their own money, so that when they went around and they talked to other synagogues, they were not bribed and given money by them in order to water down their message. Everybody produced for themselves. And so giving, I think, is extremely important, very, very important. I think those with means have a moral obligation to voluntarily take care of those who cannot take care of themselves. And I give a lot of money to specifically to organizations who I know for sure are doing that, because I've looked at their financials and I've seen what they do in person. Um, And if you look at where the vast majority of actual churches spend their money, it's salaries, real estate, buildings, and not taking care of the poor and the needy. So I give and I don't tithe. All right. Um, from Deep In Connection, how long were you creating content before your subscriber base started to hit an inflection point of rapid growth? You bring amazing insights. Well, thank you. I started my YouTube channel in like July or August of 2019. And I was making like one video a week or something. And at that time, I was also doing some other stuff. I wasn't super focused on making YouTube videos. In September of 2019, the repo market started to blow up or show signs of blowing up. The repo rate spiked. And so I spent a good amount of time researching it, learning about it, understanding it. And I made a video explaining what was going on. And that video was the first one that got like real views, that wasn't just from like, family and friends who were like, liking and commenting to try and like, help me out type of thing. That was the first video that I made that actually got legitimate views. So that was a signal for me. I was like, okay, I've been making videos for, a couple of months now, but this one actually got a couple thousand views. So I was like, okay, that's interesting. Videos after that, my once a week videos went back down, started getting normal views again. December, there was a paper that was released by Zoltan Pozar, who's the man credited with mapping the shadow banking system, and he was talking about the the repo market, saying that there's real danger that happens again. And the last time this happened, like for real, was the great financial crisis. And so I made a video explaining that paper and like, hey, like there's a risk that this is going to happen again. Because what started in September has not been fully solved. And that video got like 50,000 views. It like blew up. And I was like, okay, now I know for sure, like the thing that people want from me is explaining complex things that are happening in the economy in a way that's simple to understand. So, because nothing else that I had done like really got any views at all. And that because of that video, I got up to 1,000 subscribers for the first time. And on YouTube, 1,000 subscribers is the threshold for monetizing your account to be able to turn on like ad revenue. And so that was like the signal to me. I was like, okay, this is the thing that I should be focused on instead of, my blog, instead of my podcast, instead of the other things that I'm doing. Like this is growing faster than those other things. So I'm going to go all in on that. So I started making a video every single day. So I'd wake up, figure out what to make a video about, record it, edit it, post it the next morning. And that was literally all I did until the end of, well, obviously in 2020 hit, but I was still, making a video every day. And by the end of 2020, I think I had like 100,000 subscribers. My timeline might be a little fuzzy, might be a little bit off on that, but it was about a year and a half total before I got to the point where I was making enough money from like AdSense and a couple other, affiliate marketing deals to be able to, pay my bills. But it was a year of making a long form video literally every single day. And I edited it myself, even though I was bad at it, and did it all. And then it was kind of quick growth from there. Once I kind of cracked the code and figured it out, I was able to hire some video editors and started monetizing in different ways. And so it was 2021 when that really started to kind of take off. All right, from Cade Wilcox. I'm trying to learn to fish from asymmetric alpha alerts. I know my money will earn more following the alerts. How much of the speculation percentage of my portfolio should I use to learn versus following the alerts? That's completely up to you. I can't tell you what is a good percentage of that. I personally like sticking to around 10%, really no more than 20% for speculative trading. Because anything more than that, like you really do risk blowing yourself up, especially early on. So it's up to you how much risk you want to take with your portfolio, but just know that like worst case is you always want to plan for like what's the worst case scenario. And is that something that I could bounce back from, or how hard would it be to bounce back from that? From Mac Bones, are there places still in the world where we can dig up natural gold? I mean, yes, there are many proven reserves. Like there are many places around the world where they know there's gold and they know how much gold is in the ground, but it's just not profitable to get it out of the ground and refine it because the equipment and the cost and the energy and the manpower that it takes to get to that point costs more than $5,000 per ounce. Even though we know it's there. And so it's cheaper if you want gold to just buy the gold that already exists above ground and refined. But there's so much gold that we know of already that's just not profitable to get out of the ground right now. Are these live streams saved on the channel and able to rewatch? Yes. Every single live stream on YouTube, when you go to somebody's channel page, there's videos, there's lives, there's shorts, and there's, I don't know, a couple other little tabs on everybody's YouTube channel. And so I don't delete my live streams. They all stay posted. And also all of my shorts that I post are just clips from these live streams. So actually there's some clips from my regular YouTube videos as well, but the vast majority of them are from the live streams. So that's a quick and easy way to just scroll through and watch the live streams without, I don't know, sitting down and watching the whole thing, I guess. But yeah, all my live streams are still there. All right. From Andriy Gorodo Sky. Why do stocks continue rising? Does the market feel that the value of the world exchange currency is decreasing in value? How higher rate of income for buyers endangers the Fed? All right. Part of that I don't know what it means, but you said, does the market feel that the value of the world exchange currency is decreasing in value? It depends on, like, you always have to say compared to what. So if you're asking about the dollar versus other currencies, all we have to do is look at a chart, look at DXY. We can see that relative to other currencies in the DXY basket, the dollar has remained relatively stable since April of last year. It was more valuable in January of last year, and then it was falling and it's stabilized and now might be rising and maybe headed back into that range that it was in before. That's where I think it's going, but hasn't gotten there yet. But it's been relatively stable. But if you're asking dollar compared to gold, I mean, the dollar has gone down compared to gold a lot. If you're asking about the dollar versus Bitcoin, the dollar has gone up compared to Bitcoin quite a bit. If you're asking the dollar compared to the S&P 500, the dollar's gone down compared to the S&P 500 quite a bit. So when you're asking if the dollar is worth less or worth more, then what? It's worth less compared to beef. It's worth more compared to, I don't know, TVs. All right, question from Dano the Mano. Would you float a mortgage rate or lock it in now? We have 45 days left. Rate is at 6.3%. I would absolutely never, no matter what, in any circumstance, have a variable interest rate on any debt. There's no chance I would take that risk, because the risk is you have to pay a lot more. I'm not going to take that risk, and I'm never going to be getting into debt where I can only afford the debt if I can get the cheaper interest rate right now on a gamble. It's like that's just such a dumb, risky move. If I can't afford the fixed interest rate, I can't afford the debt. So no, I would not have a floating interest rate on a mortgage, no matter what, even if I'm super certain that interest rates are going to be coming down. All right. Question from Raymitz 4546. I can smell gum from here. When I watch you chew, I smell gum. Juicy fruit or spearmint, maybe. What was I eating before? I had white ice mint, and this new one I just threw in was white ice mint. I did have spearmint earlier somewhere. Man, where's my spearmint? There we go. Here's a spearmint. I don't like the fruit chill flavor. The fruit chill flavor is too spicy, in my opinion. By the way, I'm talking about Nicorette here. This is not normal. This is not regular chewing gum. Juicy fruit, regular juicy fruit gum is not spicy, but the fruity flavor of Nicorette is. White ice mint though is good. Does anyone have a link to the official alpha alerts Joe's talking about? I really discourage at this point people just going in blind and signing up for my trade alert service. I like to sell it through my events that I do. So if you ever see me, about once a month, I will run an event where I'm talking about something going on in the world or whatever. I use those opportunities to sell my trading programs because I get to have a lot of time to explain what they are and how they work and what you should expect out of them. And if you just go in blind, you don't really know what you're signing up for. So I like to have the opportunity to really explain it first. You can do some digging through my websites and find the place to sign up, but I really don't push that because I like to at this point I like to be able to have an event to explain it first. Um, Question from Kyle Kusin 9353. What are some good charities to give to? Um, Number one, uh, I think it's important to stay local. The reason why is because if you give to like national charities, you can't usually like go there in person and see how they work. You can't see how they operate. You can't see the people that they're helping. So there's a degree of separation where you're like, I'm not positive they're actually doing what they're saying they're doing with their money. Um, if they are national, also they usually have higher costs, like administration costs, and so less of the money that you're giving is actually going to the thing. And so if you stay local, like literally just Google or ask GPT or Grok or whatever, like for charities that are doing specific things, whether it's helping women who have just escaped, abusive households, or running like jobs programs for homeless people, or recovery programs for addicts, or literally like food pantries where they're giving food to people who are like, on the street, and go there. Like you can volunteer for a day. You can just ask, you can email them and say, hey, I'm thinking about, starting to give to you monthly. I'd like to see what you guys do. Can I come on a certain day and you guys can show me around? Like they're all hurting for money. They will all be happy to like talk to you and give you a little tour and show you what's going on. Um, they all have like little volunteer days and stuff. And so go there in person and see what they're doing. Make sure they're actually doing what they say they're doing. See how they're helping people. And then look up their financials. Every 501c3 is required to publish their financials. And there's a bunch of websites where it tracks them all and it'll give them a score. And you can see how well they do on how much of the money that is donated to them actually goes to the thing that they're doing, rather than like you give money and most of it goes to them running the next fundraiser so they can raise more money. And so that's the process that I like to follow. And that's why I don't ever state the names of the charities that I personally give to, because I think that process of go, going through and finding your own is actually pretty important to feel like that connection to it. Keeps you giving, and it I don't know, maybe that's wrong of me, but I prefer going through that process so that you know what you're giving to for sure, and you know that it's actually making a real impact in helping people. All right, next question. Jack Pearson, your motivation for starting wars is absurd unless you want Iran to have a nuke. Man, it's a bummer because I thought that last year when we bombed Iran, I thought they said, "Oh, we for sure took care of their nukes." So is that a lie? Or how about for the last 20 years? How they've been 2 weeks away, or 2 months away, or 1 month away, or 6 weeks away from having a nuke. For the last 20 years. Just do a little Googling real quick and watch the videos for 20 years. Have they been saying the exact same thing? Oh, Iran is 2 weeks away from having a nuke. Iran is 2 months away from having a nuke. Like, we have to talk now. Like, it's like, if you bought into that hook, line, and sinker. Any excuse to start a war anywhere in the world, people like you will eat it up. And it's just absurd because it just keeps people dying, and it keeps enriching the military and industrial complex, and it keeps the political oligarchs rich. All right. From Zakpa. I work in Singapore for a big private bank and I watch your channel daily. I think your videos allow me to explain certain finance situations better to my clients. Keep on doing the keep up. Please please do keep up the good work. Oh, thank you. I appreciate that. Glad I can help. That's why I do what I do. I like understanding these things myself. It helps me become a better investor and make my way through the world a little bit easier. And the more I can share that with people, I think the better. Um, do you do mentorships? This is from Hank D Tank. No, I do not. I do not do any mentorships. Little bit of a walkthrough of my business model. I make YouTube videos, and that's the free education, free content that I put out there for everybody to help anybody understand how money works so that they can make more money investing for themselves. That's time wise, spend a good chunk on that. Next layer down from that is stuff like my newsletter. So if you subscribe to my newsletter, you're going to get more like weekly insights from me. It's free, like get stuff from, on stuff that I'm not really talking about as much on YouTube because I own the list. And so I don't have to be worried about a video not getting promoted as much or a topic not being particularly liked by, by Big Brother. And then from there, I will run events and I'll offer for periods of time. I'll open up access to my trading groups, and this is because like if I wanted to, I could just stop working today. I could retire today. I don't believe in retirement. I think that people need to work and need to do something that is meaningful and providing real value in the world. But if I wanted to, I could. So if I did, what I would be doing with all of my time is really what I'm doing with most of my time today, which is looking for investments, just being an active investor, active trader. That's how I spend the majority of my time. And over the last decade, I've gotten pretty good at it. My personal compound annual growth rate over the last 5 years is 39%, significantly better than the market averages over that same time period. So a couple years ago, I was like, I should just start sharing my trades that I'm making with my paid subscribers. So that has turned into my main product. So I don't sell courses anymore. I throw those in as like bonuses, and I'm going to be opening up easier access to my education for free in the future soon anyway. So I don't sell courses. I don't sell education because today education is like, you can learn anything you want for free from anybody. Like you don't really have to pay for education anymore. So I don't sell my courses. The thing I do sell is access to just following along with the trades that I make. And the reason why I don't do mentorships is just to be completely honest with you. In order for me to make it worth my time, for the amount of time that it would take me to do like coaching, mentorships, one-on-one stuff, for the amount of money that I make per hour that I work, I would have to charge so much that it would not be worth it to anybody who didn't already have 10 million plus. If you already do have 10 million plus, you don't need it. And so thankfully and luckily, and I've been very blessed, my business has grown to the point where I'm making a lot of money from it. And so it doesn't make mathematical sense to do mentorships and coaching. So that's why I structure it the way I do, because I want people to be able to follow along with me and learn from me. And we do private live streams for all the paid people. And there's more close connection in there rather than just being on YouTube, but nothing one-on-one. All right. So Happy Days says, I don't think he was asking about fixed versus variable. I think he was asking about locking in an interest rate now versus waiting 30 days to lock it in. Oh, okay. So earlier I answered a question about locking in a mortgage rate. I thought you were talking about a variable interest rate, that like a variable loan. If it was me, I would, because you can always refinance later. I don't really, if you can afford it, then it doesn't really make any sense to try and like, you don't know what the market's going to, like today, interest rates spiked. You just don't know what things are going to do from one day to the next. But 6 months from now, a year from now, if they're significantly lower, you can always refinance. So it doesn't, in my opinion, it doesn't make much sense to try and time it down to the day or anything like that. Just if you can afford it, get it. If things get cheaper later, just refinance. Some mortgages offer free Like, you can do like a recast. Sometimes they offer free refinancing. And so that's something that you can ask about as well, just in case to de-risk yourself. Um, from Gib591, I'm considering buying a primary at the top of my a primary residence at the top of my budget. I have plenty of reserves to cover in case of hard times, but I really don't want to lose money on it. Thoughts on buying real estate right now? Your primary residence will always lose you money. Like, do not go into it with a mindset of like, I want to make money on this, because your personal residence, whether you rent or whether you buy, it's a cost, it's a liability, and you're probably going to spend more money and lose more money if you buy versus rent, especially in the short term, because you're going to be doing stuff to it. You're going to want to put in the nicer landscaping. You're going to want to renovate the kitchen in a couple of years. You're going to want to paint the walls, and you're not going to do that on a rental. But you're going to want, and you're going to want to live in a nicer area. If you're buying, you're not going to buy in the same neighborhood that you're going to rent in. Like, you're going to go into the place where you're like, yeah, I could live here for the next 10 years. Like, I could raise my kids here. I could send my kids to school in this neighborhood. Um, the only situation in which your primary residence should be considered an investment is if it's like that's exclusively what it's for. Like, you're buying a duplex and renting out the other side. You're doing a live-in fix and flip because you got a killer deal. Like, don't try and mix pleasure and investing. It's like, if you're gonna make a decision with how to spend your money, either go all in on the financial side and do it for an investment, or go all in on, hey, like, this is just for, because I want to live here. Now it doesn't mean like do something where like it's gonna like be a financial burden. When I moved into my house, the first thing that happened was the house flooded. And because of the way that it happened, insurance wouldn't cover any of it. And we had to repipe the whole house because we found out it was a mess. And it was like, before we even moved in, we were like 30 grand in the hole. Like, and so it was like, if it had happened to anybody else, if anybody else had moved into the same house, like, they would have been financially ruined. And it's like a big lesson of like, never move into a house that's like so much a financial burden that if something goes wrong, that you're screwed, because something will probably go wrong. um, and so if you can cover it, if anything goes wrong and you like the house, it's not an investment decision. It's just it's a lifestyle decision, and that's completely fine. But don't go into it expecting to make money on it, because your primary residence is a place that you're going to live, that you're going to enjoy. And either way, whether you rent forever or whether you buy a place, you're going to probably be losing money on it. All right. Let's see. Next question. Oh, from Bryson. Thank you for the super chat. I appreciate it. Thanks for AMA, sir. Any thoughts on RDW? Quite volatile, and it's only a small asymmetric play for me. Let's see. Symbol RDW. Redwire. Market cap 2.8 billion. $14 a share. Well, it looks like it's done a pretty good job of holding above this support level here at about $8 a share. It was resistance here, popped above, came here, tested, rallied, fell back down, held, came back up, fell back down, fell through briefly here, but came back above and has held so far above it again. Although we are now retesting this kind of $14 level as resistance here. So, excuse me. It looks like it'll probably be fairly difficult. This is a pretty good resistance level here at $14 a share. It did have this nice breakout here from this triangle, this wedge. So that's pretty bullish. I would be cautious here. Like, if you want to enter here, you need to be cautious that it might fall back down and come back down and retest, maybe retest here or here or here. And so I'd have like probably a tight stop if I'm entering here. If I want to be more conservative, I'm waiting for it to break above. And then again, I'm having to stop right under 14 just in case that's a false breakout. If it does have a good breakout above 14, then we're probably going to see a pretty fast run to somewhere like 20. And then the next level past that would be all-time high around 26, but it would probably be pretty difficult for it to break above there. That's just the chart that I'm looking at. I don't know anything about this company, electronic technology, aerospace, and defense. I don't know whether they're getting contracts from the government. I don't know anything about their fundamentals, their financials. But all of that stuff is being acted upon by big money, and big money is buying and selling, which moves the price, and then that price movement forms patterns and shows up in the charts. So that's one reason why I do like to incorporate technical analysis, because you get a visual representation of all of the investor and potential investor behavior that has happened based on all of the available fundamental analysis that can be done. So it doesn't replace fundamental analysis, but it gives you a good snapshot of what the consensus is of the value of this company over time. So hopefully that helps. All right. From MSLY Guitar, does that mean a super fan subscription has access to your trading group? No, it's a trading group that I have separately on a different platform. If you're interested in it, I would suggest just joining my next event that I run. Every once in a while, like once a month-ish on YouTube, I'll promote in my videos. I'll say, hey, I've got an event coming up. I'm on Zoom. I'm going to be talking about X, Y, and Z, whether it's, black swan events or, commodities or whatever. Every once in a while, I'll run an event, and I use those events to explain how to get access to my my trading group. So it's not the super fan subscriptions on YouTube. I don't even know if I have that feature turned on. I might probably do. I don't know. FlixFlux1. You've left like 19 comments so far about how rich you are. Are you talking to me, or are you just talking to everybody else? Talking about your income, your debt free, your value of your property. Do you have a question? I'm confused what all those comments are for. All right, question from V Munoz 927. Thanks so much for jumping on today and all you do. I've heard Dalio say to keep an eye on the bond market. Is today proof we should expect bond rates to continue going up? Left alone, bond rates will continue. So the 30-year spike today broke out above this resistance level here. We're at 5.1%. Just a couple of days ago, there was a 30-year auction above 5% for the first time since 2007. It's right in here. First time 30-year auction has gone for over 5%. Not a good sign. 20-year yield spiked as well. 10-year yield spiked as well. 2-year did a little bit as well. So yes, left alone, if nothing happens, these, debt will continue to get more expensive for the government. Interest rates will continue moving higher. But the key phrase there is if everything stays the same. And Kevin Warsh coming in with Stephen Moran, exiting, making way for him. Scott Bessent, the tight coordination that the Treasury and the Fed are going to have together. Bank deregulation will probably solve that problem, because banks will be able to go in and buy an unlimited number of U.S. Treasuries for the first time since 2020. And last time that happened in 2020, it pushed yields to the floor. Now, I don't think it'll have that same effect this time, but it'll push them down significantly. 10 Curl 79. Can 20% gold be 5 to 10% Bitcoin? I personally prefer 5% Bitcoin and 20% gold. You can do whatever you want. I like 5% Bitcoin because if Bitcoin becomes, universally used as the base money everywhere at some point in the future, then it's an asymmetric bet. Like it has to be worth much, much more than it is right now to support that the value of those global transactions. But it's historically speaking, it is unlikely that that happens, which means that's why I don't like a large allocation to it, because the most likely outcome is that that doesn't happen. And so I want to make sure that in the worst case scenario, I only lose a small percent of my portfolio. When you look at human history, gold has always done a very good job of preserving your purchasing power, which is why I like 20%, because it operates as like a very stable anchor in my account. It preserves my purchasing power and gives me dry powder. Like when you look at SPY priced in gold, you can see that if you were maintaining a portfolio of like 30% stocks, 20% gold, there would have been plenty of times over the past, decade where you would have rebalanced because your gold allocation would have gotten too large and you would have rebalanced to stocks from there. And then your stock allocation would have gotten too large and you would have rebalanced to gold from there. And you would have accumulated more and more of each as that balance in your portfolio goes off, and you're buying low and selling high relative to each other. It gives you an opportunity to accumulate more of both as the ratio changes. Doesn't just move in one direction. All right. Question from Alexander Toms. Bloomberg is talking about a coming oil shortage coming any week now, saying the oil market is so interconnected, it would affect everyone. What are your opinions on it? Short answer is I don't know. I think it is likely that oil stays around the level it's at right now in terms of price. It is unlikely that we see a return to how things were a couple months ago in any short amount of time. It seems as if the current administration wants things to stay chaotic. It puts a lot more pressure on other countries than it does on the US. That doesn't mean we won't feel it at all or experience any of the pain of it, but I think energy prices staying elevated is kind of like the base case scenario. Question from FlixFlux. What do I do? I need to invest for my kids' future. I want to grow this wealth, but limited assets are what I have, but no upward movements. Well, you say you have a couple million in property and no debt. So you clearly know how to build wealth. There's this idea that a lot of people have that, like, if they made their money in real estate, they're like, oh, I have to now figure out how to make money in stocks. It's like, why? Do the thing that you the most money, not the thing that somebody else might be making more money than you in, because you might be able to only make less money doing that same thing. If you're really good at starting and selling small businesses, do that. If you're really good at real estate, do that. If you're really good at stocks, do that. If you're really good at sales, do that. If you're like, with the skill set you have, it's like you don't see, like, maybe I don't know. LeBron James might look at maybe not LeBron James, but like a regular NBA player might look at a regular MLB player and think, oh man, they've got so much more longevity. They can stay in the league for so long. Like, they make so much more money. I'm going to go, try and play baseball. It's like, well, they're playing baseball because that's where they can make the most amount of money, but you're better at basketball. So you will make less money by trying to play baseball than basketball because that's your skill set. Um, so if you are good at making money and building wealth in a certain area, why not double and triple down on that? Now, that doesn't mean that you can't diversify once you've built the wealth into other areas, but it might mean maybe take a little bit of a passive approach and you like, just do the basic stuff of like, building up some index funds. If you want to try active trading, that's fine. Do it with a very, very small percentage of your money, and it'll take you a while to learn. You're going to have a learning curve. It'll take you a couple years, and you'll probably lose money along the way. And eventually, if you keep at it and learn your lessons, then then you'll improve and you'll eventually get good at it. Um, but do keep on doing the thing that you've built a substantial amount of wealth and you have no debt. Why not keep doing that? All right. Question from Robza B055. Just joined. What's your opinion on owning toll booth stocks like MasterCard, Visa, SPGI to overcome potential future elevated inflation? Um, if you look at like MasterCard, very, very solid performance. Recently, obviously, they've been selling off a bit. Might be a good opportunity if they're holding above that support level there. If you look at a stock like Visa, kind of similar. I don't know why. I wouldn't really put SPGI in there. That's not really a what I would consider like a toll booth stock like Visa or MasterCard. But because of the predictable nature, these companies are fairly expensive. I mean, a PE ratio of 28, PE ratio of 28 here. And so there is some inflation protection built in because, they basically collect percentages of global transactions that happen. So, but it's not like they're passing all that through in dividends. So a lot of that, a lot of the certainty of those future earnings are baked into the price already. That doesn't mean they can't continue to go up, but it just means that like maybe it won't have the performance that you think it will because that's already kind of baked into the cake a little bit. I don't dislike these companies, um, but they might not have the huge growth potential that you think they might. All right. Tyrox says, stop being greedy. Go to God. Money is the root of evil in this world. Well, the Bible would disagree with you about that. Deuteronomy 8:18 says, remember the Lord your God, for it is he who gives you the ability to produce wealth. If wealth was evil, why is God the one who gives you the ability to produce that wealth? In Proverbs, it says, the good man leaves an inheritance to his children's children. And later in Proverbs, it defines what an inheritance is, and it says, inheritance is house and riches. So how can a good man leave houses and riches to his children's children if money is all evil? By the way, when the Bible verse you're thinking of does not say that money is the root of all evil, it says money is a root of all kinds of evils. It doesn't even say money. It says the love of money is a root of all kinds of evils, which, sure, yeah. If you turn money is a tool, it is a good thing God created. In the Garden of Eden, God created the world. He said it was very good. And it was planted in a land where the river flowed from Bishan, where there was much good gold. God created money. And it says the love of money leads to all kinds of evils. Sure, anything that is good that you turn into a god will become corrupting for you. In fact, better something is, and the more God created something for good, the more ability it has to be used for evil and to be corrupted. And so, use tools for good in this world. Don't turn them into gods. That's it. All right. From Bulligity. There's no way they can start raising rates with annual interest running 1.1 trillion and rising. Well, yes, I agree. I don't think the market is right that they're going to be raising interest rates. The market is pushing interest rates up right now because of all sorts of reasons, mainly because of what you're talking about. Like, there's no way out of this mess right now. And if they don't do anything, we need to get compensated with a lot more interest for loaning money. So that pushes the price of bonds down and pushes rates up. They can push this down though through policy, and I think they will. And I think they will have to. All right, question from Robert Schmidt. Are you still a Christian? You said you were becoming a pastor, but I never heard you say or still a Christian. Um, I mean, I think that the things that I think are true would mean that many people would label me not a Christian. When you take a strict sense of the word that Christian means follower of Jesus, then I say that I am. But I think a lot of people would probably say that I'm not. I don't care. I say I am. When I went to school for Christian ministries and I was on that path to become a pastor because I wanted to help people. I then, when I was getting out of debt, I discovered how much I really loved personal finance and investing, and had a buddy got me a job in a broker training program, and that kind of set my career in a different direction. But it had nothing to do with me like leaving the faith or anything like that. All right. Question from, what's up, Economic Ninja? I've been live streaming now for 2.5 hours. So I was looking for you at the beginning and you weren't here. No, good to see you, man. All right. Question from Kevin Diaz. What do you think about Microsoft? Let's take a look at Microsoft. So, number one, it's a fairly solid company over the long term. If you take a look at like pretty much every time Microsoft touches its 200-week moving average, it's like you can be pretty confident that that's like a safe buying price. Now, it doesn't mean that it's always going to be, but like even going back to after the dot-com bubble burst, buying around the 200-week moving average was like a good move. You accumulated a lot of shares at like a really good price historically. And then every time, the last time it touched before right now was 2022 at the end of that bear market, and almost touched again in the bear market of 2025, just now touched again a couple, 2 months ago, 1 month ago, and has bounced off. So like, historically speaking, it's probably a good time. I don't own, well, I need to double check. I don't think I own any Microsoft. When I share my positions with you guys, it's not because I think that you should do the same thing as me. I'm only sharing with you so that you know the strength of my conviction about my opinions. All right, so I do not currently have a position in Microsoft, at least nothing outside of like an index fund account type of thing. But I that doesn't mean that I don't think it's going to do well. We have an upside down head and shoulders ish kind of pretty ugly little bull flag going on right here. So I think that the setup does look fairly bullish here. Um, Companies like Microsoft and Amazon and Apple and Google, I think, are all really, really well positioned to take advantage of what is happening right now with technology and AI. And Amazon is one of my, like, if you put a gun to my head and said that I had to invest in only one company for the next 10 years and I couldn't sell, I would probably choose Amazon. It seems extremely undervalued to me. But yeah, I don't have a position in Microsoft right now. It looks good to me. I think they will probably perform fairly well. They've been a company that has proven the ability to just outperform and perform really well over a very long period of time through different political environments, through different technology environments, through different all sorts of stuff. Like they through different leadership, like it seems to be a fairly solid company. And I don't have a position in it, but I like it. Okay, let's see here. Quick thoughts on Lulu stock. This is another one that's kind of like Nike to me. It's like I think somebody on the last live stream asked me about Lululemon, and I was like, "Hey, this is dangerous right here. Like it looks like it's about to break down, and if it does, it's going to be a pretty quick fall." Looks like that's happening now. I would say the next floor is maybe going to be 110. Like we've got some support that it might hit from right here, but we also have a gap that that never filled right there. And it's probably not really strong support there. I would I would be much more comfortable waiting for it to get down to like 80, because that $80 level is going to be a lot stronger support with how good it was, this resistance level here. But again, this is kind of like a company like that feels like Nike to me. It was like performing really well and just started making a bunch of bad management decisions and didn't keep up with the times with competing with its new competitors, had some issues, and he's been getting clobbered. I don't like catching falling knives. It's it's difficult to catch falling knives in a way that actually works without, unless you're going to be super disciplined about your stops and getting out at really small losses every time. You're probably going to bleed a lot on the way down. I would prefer with a company like this to wait and not try and catch the exact bottom. I'd like to wait for a turnaround and see, like, okay, their earnings are turning around, their management is turning around, like everything is starting to go a lot better now. They're fairly well valued. Their PE ratio is still 9. Like that's a good PE ratio. But again, you always have to ask the question, why is the market valuing it at such an attractive low valuation? Because the market expects, you know, it's not worth a higher valuation. 'Cause that's all fundamental analysis is. It's how much money am I paying for a money printer? That's all fundamental analysis and valuation is. There's a money printer sitting in front of me that prints out X amount of dollars per year. How much am I willing to pay for that money printer? 10x the number of dollars it prints out every year, 100x the number of dollars it prints out every year. You'll be willing to pay a lot more if you have a high expectation that in the future it's going to be printing out a lot more dollars. But you're only going to be willing to pay a little bit if you have a decent expectation that it's going to be printing out less dollars in the future. That's all valuation is. How much am I going to pay for this money printer? And right now the market doesn't really like it. And personally, I don't like catching falling knives or trying to. Okay. Have you talked already about why uranium stocks are tanking right now and if you expect that to continue? Um, so when in doubt, zoom out. This is URA over the past couple of years. I would not say uranium stocks are tanking right now. This is URNM over the last couple of years. I would not say uranium stocks are tanking right now. This is a very volatile market. I mean, just look at how volatile this is. The movement that we've seen recently is not out of the ordinary at all. This looks like fairly standard just price consolidation. We're seeing some just standard movement inside of a very normal range. And so I just reject the idea that this over the last couple of days, this movement means that they're tanking. I mean, percentage wise versus other things, sure. But I mean, it's that's what uranium stocks do. It's a very volatile space. Okay. Um, All right. Can you pull up silver for a quick TA and your thoughts? Also, are you adding during this pullback? Um, let's pull up silver. So silver, I expect to do basically the same thing as gold. I expect it to stay inside this range for a while. It had such a monster move, like such. I mean, look at that. Look at that monster route. Like that's something that just cannot continue for a long time without significant profit taking, without significant selling, without finding a new price floor. Like this kind of volatility we see here is absolutely what you would expect after such a monster rally. It moved from 24 to 120 in the course of from February 24 to January 26. So like in the course of just under 2 years, it like 5x'd. It's a monster move. And so now that it's consolidating above, if we go back like to its, all-time chart here, it's consolidating way above its old all-time highs. Like, I don't think there's anything like scary about this, anything abnormal about this. This doesn't reek of manipulation or anything like this is just like, yeah, it it over more than quadrupled in the course of 2 years. You have to expect a correction and a pullback at some point. I currently am like the only thing I'm doing with silver is just I'm dollar cost averaging right now. I don't have any like active trades on it. I'm just stacking more silver. Um, and my silver position is very small compared to my gold position. Um, but yeah, I mean, I'm just buying little bits here, and you get more if you nail it on the days where it's lower. Um, all right. Question from ESP Horizon. Any thoughts on if and when SpaceX and Anthropic IPO go public? I've talked about IPOs quite a bit. I don't like IPOs. I don't touch IPOs. I try and get in on companies prior to IPOs. Right now, there's a little bit of a like this. I don't talk about this very often because it's a little bit of an untested area with like the new, uh, like the deregulation that has happened recently that allows makes it easier for retail traders to get into private companies. There's a lot of potentially unreal equity. Like Anthropic just released a statement like 2 days ago, basically said if you think you own Anthropic and you don't directly own shares from like us, then you don't own any Anthropic. Like your shares are void and invalid. If you own it through any like SPV or anything like that, which is like I don't I don't know how that works. I don't know what those legal battles are going to look like. Because when you get retail investors in something and then they lose money on it, class action lawsuits just go crazy. Um, and so I don't know what the resolution of that's going to be. Um, I believe I I believe I have some ownership of SpaceX, that came from pre-IPO. It was from XAI. I owned XAI, and allegedly those are shares of SpaceX now, which allegedly are, going to be going public here. But given what's just recently happened with Anthropic, it's like, who knows? That might just be zero. Like I may not actually have any SpaceX. And so, but no, I don't like investing in IPOs because it tends to be an exit. Like if, let's say I actually do own shares of SpaceX, I'm going to be looking for an exit when they go public because it's going to be worth a lot more than what I paid for it. And so I don't know what the lockup period will end up being. They're trying to shorten it, maybe might be like, but IPOs tend to be exits for early investors. And um, so I don't like to be the bag holder, which typically happens with IPOs. If I like the company, I like to try and wait to see if it'll tank after like 6 months or a year before getting into it. All right. When you buy your gold and silver for your portfolio, are you talking about physical or do you just hold in paper? If both, how does that percentage look like? Again, thanks for all the insight. Um, I like to spread it out. I think it's kind of irresponsible to hold all of your gold or silver in one type of position. So, what do I mean by that? There's pros and cons, and there's risks to every type of gold ownership. So, if you own physical gold, like, if in my background, you see those gold bars, like those are plastic, those are fake props from Amazon. Um, that would be like, I think like $20 million worth of gold or something if that was real. That would be stupid for me to have that much gold just chilling in the open. Like, it is too easy for people, for bad actors to find out where people live these days. It would put my family in danger. So instead of hoarding gold, I do hoard a lot of lead. Um, but gold is something that, if you hold it physically, you eliminate the risks of counterparty risk. You eliminate the risk of, like, if the whole globe goes under, you still have it, but it does present other dangers and other risks. And some people live in apartments. Some people have, um, they travel a lot. Like, there's some people just don't have a situation which it's a good idea to hold a lot of physical gold. And so I think having some, good idea for most people, not for me. And when I say physically, I mean like in my own physical possession. I think the extent of it would be like a couple ounces and like some jewelry. But I don't have any significant like precious metal holdings physically in my possession. So I'm gonna have a good chunk of it in storage in countries that are economically free, that have no history of gold confiscation. So I don't vault it in America, because vaulted gold in America is what was stolen by FDR when he outlawed gold ownership. Vaulted gold in America was what was stolen by Nixon when they took it from the rest of the world, when they closed the gold window. So I don't store my gold in countries that have any history of gold confiscation. Um, Country of no history with no history of gold confiscation, high degree of economic freedom, rule of law, that kind of thing. That means you're going to be looking at countries like Switzerland and Singapore and Sweden and Ireland and maybe Australia and some other countries like that. And make sure it's in a non-government vault. It's in a private vault. So I really like that. Also, a decent chunk I lend it out. I use monetary metals. Just for full disclosure, I am an investor in the equity. Like, I'm a shareholder in Monetary Metals. They've sponsored my YouTube channel in the past. I'm a customer of theirs, so I'm biased from like literally every angle you can think of. Like, I am not, conflict of interest here. So, like, I love the company and my money's where my mouth is, but it's like, obviously I'm biased here with my opinion. So I use Monetary Metals because with some of my gold, because I earn gold ounces on it. Like, they lend it and lease it out through gold bonds and gold leases. And now it's not in storage anywhere. So it's not at risk of, getting stolen or getting confiscated. It's participating in active financing through gold denominated debt. And so I grow my ounces that way. It's not dollar denominated, it's gold denominated. So regardless of what happens with the price of gold, my ounces are actually growing. And when those leases or those bonds mature, then I can get that back, or I can roll it over into a new one. And so I think that's a great way to compensate for the price of storage. Like, the cost of storage usually costs you money unless you're lending it out, then it's actually being used productively. And so you get rewarded for that. So I think it's fantastic for not everything, but for a good, a decent chunk. GLD ETFs, those are great as well. The benefits there are it's super cheap. It's the cheapest way to own gold. It is easiest to have that exposure in things like retirement accounts. And if it's good enough for Bridgewater, biggest hedge fund in the world, it's probably good enough for me. Downside is if the world goes down and world goes under and there's, the internet is gone and like, those shares are meaningless. Same with like PHYS or those like the other like physical gold ETFs. Like, if the world resets, that's gone for you. That's you're not going to get any physical delivery of that. So there's pros and cons to everything, which is why I like to spread it out. Okay. From Rob Zabob. Thoughts on the software cybersecurity space long term, specifically enterprise software companies like Now, CRM, cybersecurity companies like PANWZS. Yeah, that's a space where I don't know. if I was forced to say whether I was bullish or bearish overall, I would probably say bearish right now. I don't have a position. Stocks like, well, specifically CRM, Salesforce, like that's one of those companies that I despise. Some companies I just either because of their leadership or because of their products or both, I despise the company. That's one of them. Like internet service providers are other companies like that. Many utilities are like that. Um, I do not like Salesforce. Now it doesn't mean that they won't perform well in the future. That really doesn't have much to do with it. But I do have a hard time convincing myself to invest in a company where I despise either the leadership or the products. And it's because if a company has gotten to the point where it can make a potential customer like really, really, really hate them, it's probably a competitive disadvantage going forward into the future versus companies where they have like a cult following and people like love spending money there. Like Apple. I mean, obviously I'm biased here because, I was talking earlier on the stream about how everything in front of me is Apple. I've got the Studio Display XDRs, I've got a Mac Studio, I've got the iPhone, I've got the AirPods, the AirPod Maxes, I've got the somewhere around here the AirPods that go in your ears as well. Like I use everything Apple. And I love it for years. Every time they have an event, I watch the event. They used to be a lot more exciting than they are now. I'll be honest about that. They're not as they're not as exciting as they used to be. But I'm continually waiting for the next product. Like I cannot wait until they come out with the next Mac Studio because right now I've got the M3 Ultra chip. I want to upgrade to the M5 Ultra chip. And it's like I cannot wait for them to come out with that so that I can upgrade. It's like companies that have like cult followings like that where their customers just are excited to give them money. Those tend to be companies that tend to perform well over the long term versus there's other companies that are just not like that. They're kind of the opposite. Now I don't know about ServiceNow or some of the other software companies that you said, but everything going on with AI right now is like there's some severe disruption. We don't have a really solid idea of which companies will be winners unless they have moats in other areas, which is why I'm so bullish on Amazon. It's like regardless of what happens with AI, the speed of acceleration in how good AI gets, that's only going to make Amazon more profitable as they eliminate people and replace them with robots. It's only going to make them more profitable. And nobody can compete with them on that because of their infrastructure that they've spent the last physical infrastructure they spent the last 15 years building out across the globe. It's like nobody can come close to that. Like anybody, maybe Walmart is the closest competitor and they are miles behind playing catch up. And so you want to find companies that have moats in other areas because just the software, just the digital product itself, those moats are very quickly shrinking. Okay. From Felix the Cat, would you explain the human behavior behind a bull flag and a reverse head and shoulders pattern? Yeah. Good question. I like that. All right, we got to find a good head and shoulders, or a good bull flag. Let's go with Eli Lilly. Okay, so this is a massive. A lot of people think that doesn't count as a bull flag because of its time frame. So I guess let's pull. Well, let's just pretend. I still think it counts because markets are fractal. So let's use a monthly chart so that the number of candles looks right. All right. So what is happening here with the behavior that causes it to happen? Number one, we have a big breakout where buyers are willing to pay more and more to get the shares, and sellers are unwilling to sell for less and less. Because anytime a transaction happens, it's because a buyer and a seller agree on a price. And so sellers obviously always want the highest price possible. And so if the price is moving up, it's because buyers suddenly become willing to pay that higher price. So you get an acceleration of buyers just kind of capitulating and saying, no matter what, I'm going to keep on buying because I want this thing. And so the sellers are able to take control of the price and it goes up. But at some point, that the buyers who are going to buy kind of get exhausted and stop wanting to pay those higher and higher prices. So anybody who was trying to sell will, if they want to sell, will have to be willing to accept a lower price in order to get out. So the buyers start to get the advantage again, because the buyers are like, well, I'm not going to pay 1,000. I'll only pay 900, or I'll only pay 800. And the sellers are like, well, I want to get out because I bought down here at 200. So I'm willing to get out here at 800, even though it's not the top. And so the buyers start, when I say buyers start winning, it's like they're getting what they want. They can buy it at a lower price. And then there's some volatility here because those buyers are getting it at lower and lower prices until the sellers are finally like, no, I'm not willing to part with my shares at a price anything lower than this. And so anybody who does want to buy, they're like, all right, well, I'll have to pay a higher price to be able to get a seller to convince me to give them their shares. So that drives the price back up. But then anybody who bought here becomes a seller here to get back out because they're like, well, it's going to top out again. And then that forms a little trend, a little channel. And anytime it gets to there, the buyers want, the people who bought before want to get out, and that pushes the price back down. Eventually, though, what happens is you break out of that trend because buyers at some point become the dominant force again, and sellers are unwilling to accept lower prices, which means that all of the sellers who were willing to sell at lower prices have finally sold and gotten out. So anybody who wants to buy will have to pay a higher price now. So when that breakout happens, there's another flurry, another rush where buyers rush in and drive the price up higher. So the bull flag ends up being a period of time in which profit taking is happening. And all of the people who were looking for an opportunity to get out have gotten out, and anybody who wasn't going to get out ends up driving the price higher because they're unwilling to sell at lower prices. So that's the group psychology that ends up forming bull flags. By the way, this is going to be very similar when you're looking at something like a Head and Shoulders. Let me think. What is a good? I think was it EW? No. EMT? No. ETN? Yeah, ETN. I think this one had, yeah, okay. So this one actually failed. This was a reverse Head and Shoulders that failed. But you have the same type of pattern here where everybody's trying to get out. And so they're willing to get out at lower and lower prices until everybody who was trying to get out has gotten out. Now anybody who wants to buy is driving the price higher. And when it reaches that same price where it was at before, all the people who bought here end up becoming sellers. That drives the price back down again. So you get this trend where the price is falling, but then the overall trend reverses. And the next time that happens, there just weren't enough sellers to get it back down to where it was before. Just there were not enough people willing to sell at lower and lower prices. And so it bottoms out at the same price, which means that the momentum has shifted. And most of the people who were willing to sell at the lower prices have sold and they've gotten out. And then that drives the price. So usually this pattern ends up being a signal that all of the buying action or selling action that caused this has now reversed and is now heading the other direction. Fundamentals will always override it, which is why this one failed first before finally breaking out. Ultimately, it did finally break out and is now probably headed higher from here. And so this reverse Head and Shoulders just did have a delay before finally seeing, and I would expect it to continue to moving higher from here. But that's the explanation of the group behavior that goes into forming really any technical pattern. All right. Question from Sneeder Solutions. How old are you, if you don't mind answering? I'm mid-30s. I probably look, I think I've always looked a lot older than I am. So most of the time people guess that I'm in my 40s. I am in my mid-30s. And to be honest, that's never bothered me. Like if you were sitting there thinking, man, I cannot believe this guy is only in his mid-30s. He looks way older. It's actually provided me way more opportunities because especially in the financial world, there's an inherent, like, are we back? Let me know in the chat if we're back. Let me know if you can. Okay. All right. All right. We're back. All right. I was talking about how old I am. I've always been okay with people thinking I'm older than I am because that's given me opportunities. People don't have given me more respect and just assumed maybe more competence than I deserved especially when I was younger, because I always looked older. Um, and so uh, and so I've always looked older than I am, and that has actually served me pretty well over the past my whole career. Um, but also I think some of it has to do with the fact that recently, like I pretty much every morning I spend time in the sun in the morning, probably more than I should, and so my skin has started looking a little bit more leathery, which again, I'm okay with the health benefits that I get from that. Like, I don't care if when I'm 90, if my skin looks perfect, like who ca who cares if their skin looks good when they're 90? Um, so I make sure I'm not getting sunburned or anything like that. Um, but anyway, I'm in my mid-30s. All right. 3 hours and counting. Yeah, I'm probably gonna end this in a couple of minutes here just because I've got some other work I need to get done today, and we've been going for a while. You guys just keep on throwing in good questions. So, um, from Guitars and Adam, why not just look at volume profile to see where buyers and sellers interacted the most and the least? Yeah, you can. That's definitely a tool. There's no right or wrong tool. Like, they're all helpful. The simpler of an approach you can take, like if that's the only thing you use and you learn it really well and you get good at it, then like fantastic. I really like the approach with technical analysis of having a couple of tools, just a few that are simple, that are really commonly used, that you learn really well and you use over and over and over again. The simpler the better. The more you try and learn more, sophisticated and, uh, tools that are not as commonly used, the more you're setting yourself up for just not being as effective. Volume is a fantastic tool. All right. All right, guys. That's it. This was a 3-hour stream. My voice is kind of gone almost. So I'm gonna cut it off here and end it here. Really appreciate you guys. Lots of great questions. And like I've been saying this a lot, I'm gonna try and do more live streams lately. It just I haven't been able to. I've been busy with a couple other things. I've been um getting behind on some stuff, and so I haven't had the time to live stream. But um catch me when I'm live. If not, you can watch them after. And all my shorts, if you ever see my shorts come up on YouTube, the vertical ones, those are all clips from these live streams. So that's another way to get to view these things. So appreciate you guys, and we'll see you on the next one.